very much for the organizers for inviting us. Can you see the slides? Can I just check? Is it full screen? All good? Yeah. So this is joint work with Peter, and the title is Clients Connections, Measuring the Role of Private Information in Decentralized Markets. And the usual central bank disclaimer applies given that I work at the Bank of England. So in this paper, we're asking an old question in finance, which is, how do we measure the role of private information in financial markets? So this question is particularly hard to answer because neither private information nor the identities of its owners are readily observable to the econometricians. So the main contribution of this paper in a nutshell is basically we proposing a new proxy for private information in dealer markets, which we call clients connections. And the definition of this of connections is essentially the number of dealers with whom a given client trades in a time period. And I'm going to show you exactly what we mean by that. So just to give you the main findings up front, we find that this time variation in connections is indeed a good proxy for private information. So clients make systematically more profits when they trade with more dealers in OTC markets. We also find that this effect is entirely driven by what we call more sophisticated clients that would include hedge funds and asset managers. So these are the type of traders that are more informationally sensitive. And then we also move from these microeconomic set of results to the macro, and we can measure the total number of connections in the whole market, and we can show that total connections in the market can help explain yield dynamics. So it's relevant for potentially for the macro finance literature as well. And then, given we've sort of shown you this proxy, and we've shown the connection between this proxy and performance, we offer you a couple of applications. So in the paper, we have two applications in particular. We use our proxy to show that dealers in OTC markets pass on information that they acquire from their informed clients to their subsidiaries. So there is this application about dealers learning from informed order flow that I'll talk about. And also a second application looks into the nature of private information that is proxied by connections, and we show some evidence that this measure is related to the future order flow or information about future order flow of the given market. So let me just give you the outline of the rest of the talk. So first, I'm going to give you some information about the market structure. We're going to look at the UK government bond market, and I'm going to tell you a little bit about the data. Then I'm going to show you the baseline results, and I'm going to show you two applications that I just mentioned, and a provocative, highly policy-relevant sort of event study. We're going to zoom into the Brexit referendum period, which happened on a Thursday a couple of years ago, and we're going to sort of try to see whether those clients who had unusually large number of dealer connections on those days made abnormal profits. So that's sort of a suggestive and illustrative evidence of what we talk about. About the market structure. So this is the structure of the UK government bond market, but in fact, the US Treasury market is very similar. So there are three layers in this market. The black circles are the clients. So we're going to have about 500 clients trading in this market, covering virtually the universe of the clients' sort of trading volume in this market. The second layer is the red guys. These are the dealers that in the UK we call them GEMs, gilt-edged market makers. So these are Lloyds, Morgan Stanley. These are the big banks, and they are the ones who are allowed to go to the primary auctions when the debt management office issues new debt. And you have the sort of interdealer broker market, these six guys sitting in the middle, intermediating amongst the red layer. So in this paper, we're focusing entirely on the outer layer and the middle layer. And here I can now illustrate what we mean by connections. So basically, when a client trades with, let's say, Lloyds and Goldman on a given day, then we say that this client has two connections. Then on the next day, it might be that this client trades with Lloyds, HSBC, and Goldman. So on the next day, you would have three connections. So our paper exploits predominantly this time series variation in clients' connections. And this is the source of variation we're going to use to identify our effects. And the good thing about our data set, which I'm going to talk about next, is that which allows this analysis to be executed on the first place, is that clients in our data are non-anonymous, so we can observe the identities of both counterparties. So both the seller and the buyer for each trade is available in our data. And this is delivered to us by the Zen database, which is a database maintained by the Financial Conduct Authority. And the data in this paper covers 2011-2017. So this paper was written before the COVID crisis, but in a separate paper and in an updated version, we look at the COVID period as well. But here I'm just talking up to about using the sample up to 2017. And as I said, for each transaction, we have the standard information for trades, price, quantity, direction. But more importantly, for each trade, we see the identities of both counterparties, unlike other data sets often used in the literature, like Trace database for the US. We have this additional nice feature. We have about 500 clients, covering about 80% of the trading volume, and the rest of the information comes from data stream about closing prices, basic yield characteristics, etc. So in this picture, I just let me just illustrate connection, give you a little bit of background about our main measure, which is clients' connections. On the left, I show you the cross-sectional variation of connections. So for each client, I count up the average number of dealers that they trade on a day. So you see that the distribution is skewed. So you have these clients who, very few of them, who trade with a lot of dealers on a given day, but most of the clients trade with one or two dealers on average. So the cross-sectional distribution has this kind of a skewed shape, and the standard deviation is non-negligible. So the 90-10 range is 2.4. Now, on the right, we essentially purge out a client fixed effect from clients' connections, and we're focusing here on the distribution of the time series variation of connections. So and this is how this whole project started. We observed that there is a non-negligible variation in the time series. So the same dealer, let's say, who on average trades with 4, is sometimes trade with on a given day with 5 or even 6 dealers compared to other days. So clients systematically vary the number of dealers that they trade in different trading days. So this is the time series variation, which allows our regressions to be estimated. How do we think about this in terms of theory? So in the paper, we're offering sort of a stylized model to formalize some of the costs and benefits of connections. So the way we think about this in a sort of modified Gloucester-Milgram model is that the benefit of connections is related to the client's ability to hide private information and slow down sort of information diffusion and reducing price impact. The cost of connections in our model is got to do with the cost of establishing new dealer connections. So it's costly because it's costly to establish new relationships. So what we show is that clients would trade in more dealers only if the private information is sufficiently precise. If that is true, then we should observe in the data that more connected clients by trade would predict higher future value, or when the client is selling, then they should sell before prices fall in value. We also show in this simple model that this relationship is particularly strong around informational events, so high volatility days, and also is more pronounced for informationally sensitive clients, such as, for example, in our data, hedge funds would fall into that category. So given the time constraint, I don't have time to give you more details about the theory, but you can think of it as effectively a different version of Kyle, whereby instead of splitting your trades over time in OTC markets, you can split your trades in a cross-section. And then from this theory, we derive 4 testable hypotheses. The first one is that a given client should trade more profitably in a time period when dealing with more dealers compared to other periods. The second hypothesis that this effect between trading performance and connections should be stronger for these informationally sensitive, more sophisticated traders, such as hedge funds. The third one, which is kind of important, that it should not be about getting tighter bid-ask spreads. So more connections is not, if it's about information, we shouldn't just be picking up the effect that reaching out to more dealers would allow you to transact at more favorable prices. If it's about information, we should be observing that the effect is concentrating in the client's ability to better predict future price movements. So this is about anticipation of future yield changes. And the fourth one hypothesis is that, which is a sort of exploring the aggregate implications of the result, we should find that periods with higher aggregate connections should be associated with larger yield volatility. Okay, so let me just give you sort of the baseline results before I go to the applications. So to show this performance connection relationship, we have to first measure performance. So the way we do it, for each trade, we essentially look at the percentage return on that given day on that given trade signed by the direction of the transaction, Sij tau. So let me just give you an example to illustrate this measure. So for example, on a Monday, you buy the bond at £100, and 3 days later, the price of the bond is 120, that on that trade, over the 3-day horizon, you would make 20% gain. So for each trade, we calculate this performance measure at different horizons, 3-day, 4-day, up to 20 days. And then we're going to have sort of an average value weighted measure on a given day for a given client. Now, as I mentioned, we would like to distinguish whether it's about the client's ability to predict future price movements or the client's better ability to transact at more favorable prices. So we can decompose this measure into what we call a transaction component and an anticipation component. So we add and subtract an average transaction price in a given bond J on a given sort of tight time window around the transaction. And just following on my example, so it could well be that on Monday, when you bought the bond at £100, everyone else in that tight window was buying it at 105. So basically, we add 105 and subtract from it to get this transaction cost component and anticipation component. So in this simple stylistic example, the given client would make 5% transaction gain and 15% anticipation gain on this given trade. Okay, so given our measure of performance, we just run a simple regression model, a panel regression model, where on the left-hand side, you have this weighted performance measure for client I on day T over capital T horizon. So it could be 3-day, 5-day, up to 20 days we're looking at for capital T. And on the right-hand side, we have our measure of dealer clients connections with the dealers. So this is just the number of dealers they trade on a period on a given trading day. Plus we include control variables such as number of transactions on a given day and a trading volume and some fixed effects. So basically the beta coefficient is the object of interest here. And the beta would tell you how much more profitable a given client is trading the same amount of gilts, the same amount of trading volume, and the same number of times, but doing all that with one additional dealer. So what's the marginal value of an additional dealer connection, if you will, of the given client? So that's what the beta is measuring. So we're not simply picking up that you're trading with more dealers because you're trading more. We're controlling for volume and intensity in our regression. So now I'm going to show you this beta, the result over the next 20-day horizon. And this is what it looks like. So you can think of it as sort of an impulse response function in some ways. So what we show here is that basically, for example, at the 5-day horizon, one additional connection with a dealer is worth about half a basis point for the given client. So this is our baseline result, and this result seems to be persistent. Now, we're going to split our regression into two groups. We split our clients into two groups, those that are sophisticated, hedge funds and asset managers, and those that are less sophisticated, so everyone else, including foreign central banks, pension funds, insurance companies. And we run this regression for the two groups. So on the left, you see the result for what we call the more sophisticated guys, and we see that our baseline result is entirely concentrated in these sort of informationally sensitive traders in the market, whereas for the control group, if you will, we don't find any significant relationship between dealer connections and performance. So this is kind of suggestive that indeed what we're picking up here is information related, indeed. Now we also cut a sample in terms of the time series of the trading days, because we have trading days which coincide with the impending announcement, some big macroeconomic shock. So some big macro news coming the next day. So we can check whether our baseline result is more pronounced before a big macro shock hits. And we find that indeed these information intensive days seem to increase this performance connection relationships. On the left, you see the effect before big macro shocks, which basically cutting the 1,500 days into two groups. About 750 trading days are used to run the left-hand side of this panel, and the remaining 750 days the right-hand side. So this again is suggestive that it's our connection performance relationship is related to informational mechanisms. And now the hypothesis 3, which was about anticipation of the given clients versus the transaction cost. So we can decompose our baseline 5-day effect. I mentioned that was about half a basis point. So one dealer connection is worth about half a basis point. Now we can see how much of that is indeed coming from better transaction prices as opposed to the client's ability to better predict future yield changes. So we see that the majority of our baseline half a basis point effect is concentrated at the anticipation components. Whilst is it true that when you have more dealer connections, you get tighter bid-ask spreads and you get better deals, but the majority of the effect is about the client's ability to better to predict future returns. Okay, so that leads to the last sort of macro hypothesis. So do total connections in the market explain yield dynamics? So what we do here, we just count up the total number of connections in the system, and we correlate that with the volatility of yield changes. So here we do control for trading volume and the number of clients in the market. So we're building here on this old literature. It takes volume to move prices by Karpov and others. So we just want to see whether total connections perhaps subsume or dominate trading volume in explaining yield volatility. And let me just show you one table that it is indeed true that trading volume is related. So when on a given trading day, you have high trading volume, indeed you have high price volatility, but we also show that when you have a lot of connections in the market, then you have a lot of volatility. And in fact, when you include both trading volume and connections in the regression, connections seem to dominate this effect. And also, it's not just the mechanical effect of connections is high, perhaps because you have just more market participants in the market. So we control for number of clients. So it's effectively the number of connections per client which matters and not the total connections. So we're not really just picking up the mechanical effect of new traders coming into the market. And that's why you have high total connections in the market. Okay, so that that concludes the sort of main part of the paper. And now, given the remaining 6 minutes, I'm going to try to give you some applications. So the first application is about learning. So we're trying to test this idea that dealers might be learning from observing informed order flow. And basically, given that connection is a proxy for informed trading, we can check whether dealers perform better when they trade with more connected clients. So that's the sort of that's the way we apply our method or our measure to this question. And in this identification strategy, we can distinguish between market making accounts. So let's say Goldman Sachs is trading as a dealer in this market, but also Goldman has its asset managing branches. So the kind of cool thing here, we can isolate trading accounts that are not market making functions from the primary dealer accounts. And I'm going to sort of illustrate that in a picture in a second. So our test is essentially to explore whether given dealer's affiliates, like the asset manager branch, would perform better when the given dealer is trading with high connection clients. So let me just go back to the picture because it's a bit of a mouthful. and just illustrate what we do. So that's our basically structure of the UK gilt market. So as I said, we try to understand whether Goldman as a dealer learns from trading with informed clients. Now, how do we do this? So we know we have this measure. So the green clients are the unusually high connected clients on a given day, and the blue guys are the less connected clients. So we essentially compare trading days when Goldman is trading with a lot of informed clients to days when Goldman is trading with even more informed clients. So many more green clients on T+1 compared to T. And now the research design is then we're going to check whether the asset manager accounts of Goldman and that asset managing branch is trading with other dealers, HSBC, JP Morgan, whether Goldman as an asset manager performs better when Goldman as a dealer is trading with more or less number of connected clients. So that's really the research design here. So what we call the affiliates performance, the Goldman asset manager's performance, is now regressed on a measure what we call information share, and that information share measure is just the share of the green clients, the very connected clients trading with Goldman as a dealer, as a fraction of the total trading volume that Goldman as a dealer is conducting. And what we find here is indeed when Goldman as a dealer is interacting with a lot of these connected guys, then Goldman's asset manager branches are better at predicting the next 1 and 2 day price changes. So interesting, there is no contemporaneous effect here. So it's not that Goldman as an asset manager is getting a better 0-day performance, so getting better transaction prices. But again, we find some better ability of the dealers' affiliates to actually predict that future yields are going to move. So that's sort of application 1. And application 2, I'm just going to flag, given that I have a couple of minutes left. We try to sort of explore the nature of private information that's proxied by connection. So I showed you that some of this information is related to macroeconomic announcements to the extent that this connection performance relationship is more pronounced before macroeconomic news. But it's not to say that there is also information relates to order flow related concepts. So we're building on this literature by Green and Brandt, which looks at how order flow is driving prices in government bond markets. So just to flag, given the time constraint, we had this sort of challenge, how to measure the relevant information about future order flow in our study. So we came up with this measure. So again, I'm just
Gabor,
yes.
Time constraints. Could you possibly finish in the next 5 minutes, please?
Yeah, 5 minutes is plenty. Yeah, I can finish earlier than that. So this second application, in the second application, we check. So if you focus on the left panel, on a given trading day, we check whether a given client is buying or selling the short, long, medium ends of the yield curve. So we put the yield curve into 5 buckets, so 5 segments based on maturity, and we just check what segments of the yield curve the given client is buying. So we show that this given client is buying a lot of the short-term stuff and selling long-term government bonds. Now we can check that lowercase h days later, what will the market have done? So we will see that the market over the next 5 days is indeed doing something similar that, let's say, our given client was doing 5 days before. So if I put these 5 observations on a scatter plot, then this is essentially our slope, or this new concept that we're introducing in the paper. But the slope of this regression line captures the client's ability to better predict the future order flow, or more precisely, the composition of the order flow. And in the paper, we show that when a given client has a steeper slope, it indeed makes more money. So those trades that the client is making on capital day T are indeed more profitable. The steeper the slope is, the better the given client's ability to predict the future aggregate order flow, the more money the given client is making. And then we show that this indeed, this slope is steeper when the given client has more connections. So that's how we're linking our connection results and this order flow measure. And in fact, we can actually show you this regression slope in the data. And before I giving you the details, I have a few minutes left. I'm just flagging that this is what we reconstruct in the data. We indeed show that on high connection days, if you look at the top row of this chart, the given client has a better ability to predict the future order flow when it has more dealer connections compared to the low connection days, if you look at the left-hand side and the right-hand side. In terms of the first and the second row, we also show in the paper that the client is better at predicting the order flow intermediated its own dealers, the dealers that it's trading with. So if you look at the top versus the bottom, whereas the given client does not have a better ability to predict the order flow intermediated by all the other dealers. So it points to the story that DiMaggio and others also mentioned, that perhaps the dealer, either intentionally or unintentionally, disseminating some information to these clients, and that's why, which pertains to future order flow, which the client is exploiting and thereby making more money. So we have more details, and apologies, I don't have more time to give you the more details on in this presentation, but the paper kind of explains in further detail. So the last application, the last example, just in the last 2 minutes, I wanted to highlight this Brexit sort of case study, which was kind of interesting to us and my policymaker colleagues, the Bank of England. So 23rd of June, so that was a Thursday when the referendum happened. And what happened the next day, then prices jumped, so yields went down quite sharply. And so what we did here, we just wanted to zoom in on the Thursday. So before that news arrived on Friday, we wanted to see which were the traders that were trading heavily on the government bond market, and which were the traders that had unusually high number of dealer connections on that Thursday. So basically, we have this for each client. I can calculate I can put these clients who traded on that Thursday into 2 buckets. So there were about 125 clients. Those had unusually high or low number of dealer connections. So basically, we have 63 clients who had low connections, 62 above the median. And we find that whilst they were trading more, so there's high connection clients, and those high connection clients were the ones who made lots of profits, but the sign duration was orders of magnitude larger. So those high connection clients were really going long on gilts. And in fact, I zoomed in, and next Monday and Tuesday, I checked some of them manually, and they were selling lots of bonds after prices have gone up by 3 days later. So let me just show you sort of the average duration or the average trading volume, net trading volume of these high alpha guys, high connection guys, the red guys, and the blue guys. So they were not only buying on the 23rd of June, but they started buying already on Tuesday and Wednesday. So we're really buying lots of gilts before prices went off the roof. And if anything, low connection guys did not really, if anything, they were sort of going short on gilts. So that's sort of an illustrative example, and it could be lots of other things going on, but it sort of highlights that high connection clients might indeed have some sort of information about impending future news as well. Okay, and I'm gonna just finish that. Yeah, the main contribution of this paper, because lots of papers on empirical OTC markets are looking at these issues, but the main contribution of our paper is really exploiting this time variation of connections. So existing papers typically looking at the cross-sectional variation of very central dealers, less central dealers. Our paper is really pushing that it's the time series dimension of it. And I can just leave you with the concluding slide.
Thank you very much. Now, can we turn over to Norman, please, the discussant?
All right. Thank you so much for having me. I really feel honored to be part of this conference. I'm kind of jealous. I live in Switzerland, and I don't have a conference with the BIS. So the paper. This is a very nice paper. It's very polished already. There's a lot in the paper. It was really eye-opening to me. Focusing on information in decentralized markets. But because it's already pre-polished, I'll try to be more forward-looking in my discussion than I usually would be. So let me start sort of more big picture. Last year, we've seen basically at the beginning of COVID that over-the-counter markets, there are times when they're really not functioning well. We've seen the treasury market dysfunction in March 2020, where the correlation between equities and the treasuries turned positive. We've very quickly seen a spillover effect to other OTC markets like corporate credit markets and so forth, and that basically triggered this massive Fed intervention we saw last year, where we went from a balance sheet of 4 trillion to 7 trillion within a few weeks. Now, this is called, many people have, as a result of this, and not just as a result of this, but already before, called for reforming repo markets. And there are a number of good reasons why OTC markets, may not function as effectively and provide liquidity as effectively as we think. They are not very tightly regulated. Most of the regulators of these markets are self-regulated. They're industry groups like FINRA or NSRB in the US. The market structure is opaque and fragmented. As a result of this, people have documented that the dealers in this market have market power. As a result of all this, we've seen regulatory pushes towards more transparency in those markets. So we've seen things like Trace evolve, MSRB, and I guess the paper here, that's maybe the link, the closest link to the paper, that Zen database is a result of this initiative of having more surveillance and supervision of the market and maybe more transparency, even though, from what I understand, the data itself is not available to market participants. At the same time, and I think this is also goes for the gilt market, the trading technology itself is pretty old-fashioned in that it's mostly telephone trading. There's some email-based trading. So there's a lot of recent development and also regulatory push to more electronic trading or all-to-all trading, meaning disintermediation, cutting out the dealers in these markets, pushes towards a more central clearing of certain contracts and so forth. And just more specifically about the gilt market and other OTC fixed income markets in Europe, we've seen investigations at the European level, but also at the UK level into dealers forming bond market cartels. So they seem to be maybe not as competitive as our theories, at least the baseline theories would suggest. Here is where this paper comes in. What the paper basically says is that informed trading is a major concern in the US, in the UK gilt market. They provide evidence, and the way they show this, they provide evidence for order splitting by informed investors. Now, the way order splitting usually works in equity markets is that informed traders split orders over time and over trading venues. And what's kind of special in this market, what Gabor documents, is that in this dealership market, the way informed traders trade is they split orders across different. So in other words, it means dealer connections are valuable to spread adverse selection risk across different. Now, if you look at the numbers, the cross-sectional mean of number of connections that they document is about 2.5. That means a client trades on average with 2.5 dealers on a given day, but there's a lot of time series variation. Sometimes it's up to 4 different dealers. So what they document is that at times when a client trades with more counterparties, the realized spread on the transaction goes down by 0.5 basis point. You may say maybe this is not a big number, but in like fixed income markets that tend to be very liquid, this is a big one. This is a big event. Now, what's the mechanism they have in mind is that when a client has more precise information, the client chooses endogenously to connect to more dealers in order to hide that information. So they propose this number of client-to-dealer connections as an endogenous measure of private information. Now, of course, market participants, since the market is opaque, can't really observe this number of connections, but the regulator can. So maybe the regulator can use this in their surveillance. Now, in the second part of the paper, what they document are some really interesting facts, is that when it comes to price discovery, the aggregate number of connections improves price discovery by explaining daily yield changes. The connections seem to proxy for information about both future fundamentals and future order flow, right? You might think ex ante, the fixed income market, the treasury market is like one of the most liquid markets. What would that private information be? I thought that part really insightful. Oh, it seems like there is information about fundamentals and future order. And in the last part, they show that dealers learn from the informed clients and pass it on to their affiliates in order to trade into dealer market. So that's a bit like the DiMaggio. Now, if we dig a bit deeper into this mechanism and we decompose the effect, what they show is that one extra connection reduces the realized spread by 0.5 basis point. But really, most of this effect comes from a bigger price impact of trades on days when there is a high client connectivity. The other interesting thing is there's also a reduction in the effective spread of 0.1 basis points on those days. So basically, this means two things. It means on days with a lot of connections, the trades seem to be more informative. So the BT in this picture is higher. But the other interesting effect is that the clients, despite the fact that there's more information in the market on those days, the clients do seem to get better prices with a little PT. So in short, what that means is prices overshoot on low connectivity days and they undershoot on high connectivity. And I have to say, I thought this was really interesting. I didn't fully understand it. So I went to the model, but let me just put it in perspective. Where does this paper fit in the literature? There are basically two types of strands of the literature on OTC markets and understanding what are the main frictions. I would say one is liquidity-based trading and liquidity-based frictions. The other one is information-based trading. Maybe Daphne Gallia-Pedersen is one representative. Dimitri has a paper on this where search and matching frictions are really important. There's another strand of literature where dealer inventory and balance sheet constraints are really important. And there's a literature where asymmetric information and adverse selection is important. That part of the literature is not so well developed so far, but this is exactly where this paper contributes. So what they show is that informed trading seems to matter a lot in OTC. Now, from reading the paper, what I was left with, what I didn't quite fully understand is what exactly is the difference with order splitting in stocks. I understand you split across dealers instead of time, but I can also split across venues and stocks. So maybe that is not so insightful. The other thing I didn't fully understand is what do we really learn from this paper about optimal market structure? Can you say a bit more about what your findings apply about? Does the market work well or does it not work well? Should we reform? And the second question that keeps sticking in my head is, well, isn't in OTC markets one big difference to stock markets that the participants, the clients, are non-anonymous? So I was wondering, one argument we hear all the time is that the non-anonymity of OTC trading should alleviate adverse selection friction. What I was left with is I don't understand why. Does it happen here or why not? Why does it not happen? So I went to the model. It's a Lost and Milgram type model. Unfortunately, it's in the appendix. This is probably the editor and the referees making it do this, but I think the model is really insightful. There's a client that is informed with some probability, has a precision, and in this model, a priori, you want to get votes from as many dealers as possible in order to minimize the adverse selection risk. But there are two frictions built in the model. First, the client commits to a fixed network size, ex ante, before knowing the signal. And second, the client has to pay a reputational cost for contacting, but not trading with more dealers. But on top of that, the dealers, for this mechanism to work, the dealers cannot distinguish whether a quote request comes from a client or a noise trader. And that's what gives you the mechanism that basically when you go from a small network to a big network, the dealer faces now informed traders with lower probability, and as a result gives better pricing. The cool thing of this paper is that it explains the two results I've shown you before is that information quality increases in this information precision. So does the network size, and so that explains why the VT goes up. At the same time, the clients get better prices when they're more informed, if and only if a certain condition is satisfied. And that explains why more informed guys actually get better prices on those. So I thought that was really neat, and that's a very nice insight. And I thought this condition that they have in equilibrium, that's something they could have exploited more. They didn't. But I have two questions. Well, actually, do I believe that reputational costs are really important in OTC markets? Maybe that's a philosophical question, but I think it's an important one. And again, the second one is, what about non-anonymity? The model assumes anonymity. It's an equity market model. It's not really an OTC market model. So here are my thoughts. These are some pictures and tables from a recent working paper on all-to-all trading in corporate bond markets in the US, so not exactly the same market. What you see on the left is that open trading, that means trading between end clients, cutting out the middleman, the dealer, has increased quite a bit in corporate bonds. It has gone basically from 2014 from almost 0 to now 15% of all trading. So all-to-all trading is important. But what's more interesting and more related to this paper is that if you look at the amount of RFQs, requests for quote, that actually have this all-to-all option enabled, that's like 91%. So in the model, in the paper, it's like you have to pay a cost to expose your orders to many counterparties. But it looks like in practice, everybody does it all the time when they can. So I'm not sure that reputational costs can be so high. So I don't know what would happen if their cost is not so high. Now, my second comment, well, OTC markets are okay, but at the same time, they're non-anonymous. And because they're non-anonymous, I think client-dealer relationships, they matter. Networks matter. And here I plot results from our paper in the JF on insurance company trades. It's a bit hard to read, maybe. We sort insurers on the x-axis, dealers on the y-axis. And what you see is some interesting matching. You see that small clients usually match with large dealers, large clients but match with large dealers, and large clients also match with small dealers. And small clients and small dealers almost never match. But what's more important is it seems like the trading costs are relationship specific. That's what you see on the right. They don't just depend on the number of connections. And maybe that is something that is left out in the paper. So my question is, when the clients expand their network, who do they really rip off? And why do the dealers let themselves get ripped off? So maybe a better model to think about this market is, in fact, one of Peter's papers, one of the first papers that looks at non-anonymity and informed trading in OTC markets. And there are two results that I want to highlight here from that paper is that trading costs, they are determined by dealer centrality, they're client dealer specific. And on top of that, OTC trade in that model can increase or decrease welfare. And one big effect that goes on in the paper is that price informativeness is limited. So a natural question I have is, can you provide some evidence that price informativeness is limited in UK deals? I think then you really can talk about welfare. That would be something I'm very interested to do. John, do I have more time?
Well, it's great. I'm concerned nobody's asked to ask any questions. Does that mean people don't want to say anything or ask questions? If you do, anybody please out there, put in to the chat that you would like to talk and we will unmute your microphone. But in terms of anything, let's carry on as we are with Norman, and then Gabor could reply, please.
Okay, so then I just give one or two more specific comments. As I said, the paper is already very polished. So the only thing I can imagine I would be interested in learning more about, what happens pre-trade. You talk about a lot what happens post-trade, but I think if you want to disentangle informed trading from liquidity provision by the clients, we also have to look at pre-trade. So here I put on the right, I take the picture from the paper and I add two lines, and it looks like depending on what happens before the trade, maybe consistent with like theories of Duffy or Naschert and Melkfeld and so forth. I think you would have different predictions for the different theories what happens So what happens before pre-trade? So maybe that's one thing you could look at if it's not really the case that maybe these clients, when they're more connected, it's just they provide more liquidity, which I think could also explain the results after they trade.
Like waiting for buses. Now none come along, and then 3 come along at once. So we've got 3 people who would like to ask questions. And might I propose we allow them to speak, and then turn back to Gabor and Peter for the reply to everybody. So starting with Dimitri, please. Vayanos.
Okay, thank you. So yeah, I thought it was a very interesting presentation and a very interesting discussion as well. So I would like to kind of pick on a point that Norman raised and maybe expand it a bit, which is this non-anonymity. So in principle, kind of if a client trades with a dealer repeatedly, they might want to have a reputation of not exploiting the dealer or whatever, kind of screwing them over when they have good information and the profiting at the expense of the dealer. Of course, there is the effect that you saw that maybe the dealer can use that information later on, etc. But anyway, there is this reputation concern. So what I would like to know is on the days where these clients trade with more dealers, is there kind of some variation, for example, in the pricing that they get from these different dealers? Do they get better prices from the dealers that they trade more frequently with than the new dealers they approach? And perhaps because the new dealers, there's not this reputation, kind of this long-term relationship with them. And more generally, kind of give us a bit of insight on this, to what extent can reputations develop between clients and the dealers that they trade with more frequently versus the new people that they approach? Maybe if you could, I mean, this is a point that Norman brought up, maybe you could elaborate a bit more, Gabor, when...
Hi. Yes, my question is about how dealers identify informed clients, in the sense that in the data exposed is easier to see, but in real time, dealers need to identify, need to have a signal. So I was wondering if that has to do with reputation. So dealers know that a certain client tends to be kind of informed on average, or if they can exploit the fact that maybe they see a bunch of clients that they usually don't interact with, kind of asking questions, asking to trade, and so they can infer that some of these are kind of informed. So just a general question in terms of how dealers learn who's informed. Thank you.
Thank you. Andreas Schrimpf.
Yes, thank you. So I'd have a question on this result on the benefits for the dealer affiliates after seeing the informed order flow. So, and in particular, I mean, obviously they can't really front run their clients' trades. I mean, they're under some fiduciary requirements, the dealers with regarding to the information that they receive from the interactions with the clients. So, and there are Chinese walls. So I was wondering, how do you see actually this information flow in practice happening against the backdrop of all these constraints? So how would this actually work in practice? What do you think?
Okay, should I answer like a few of them? Is it the time?
Peter, go ahead and I'll chip in.
I think also there's a question. I think probably John's connection has dropped. So let's also maybe take also the question by Hyun that has put on.
Yeah, exactly. Sorry.
Okay, thanks. I was wondering how the dealer balance sheet constraints are entering this story as well. And just thinking back to the March episode, an alternative story might be something along the following lines. There's a difference between highly leveraged players who also are the sophisticated ones. They're the ones that will be feeling the constraints binding first. That's when also the dealers are going to be constrained. So having more dealers is an indication that dealer constraints, so there could be a kind of, constraint in the supply of dealer capacity. And as the sophisticated people are selling, the prices move. There are these pecuniary externalities that drive other sellers to also sell. I suppose one way of testing this is just like your Brexit referendum story. Do you find evidence that the sophisticated people actually buy back once the price has fallen? I mean, I think that would be a very, that would be a clincher. If it's a more of a distress story, they wouldn't be buying back. I mean, they would just, stay on the sidelines. So I'd like to sort of, hear hear from you about this alternative story.
Okay, I think we better turn back to Gabor and Peter to reply to a whole collection of questions.
Yes, thank you very much. These are extremely interesting questions, and I will pick a few and answer to my greatest knowledge, and then Gabor will follow with his even bigger knowledge to answer the rest of them. So, this anonymity is an interesting question, and its play with reputation and the relationship between dealers and clients. So let me kind of give you like a kind of a big picture of how we think about this. So kind of the idea is that
Peter,
yeah?
not too big a picture. Can you keep the whole thing down to 4 minutes, please? I'm so sorry. 4 or 5 minutes.
I will. So the idea is that whenever the information content of order flow is kind of large, that's when dealers suffer. So basically, kind of the idea here is that whenever some clients have more information, they are kind of like spread out their trades across many dealers, which is good for the dealer because he's kind of like facing less of adverse selection, and it's good for so basically there's kind of a pie because of the less of the adverse selection. There is a pie to share. And then what we basically show is that some part of this pie is going to the client. So the client can extract this gain that whenever there is more information on the market, it's spread out across more dealers, both in the micro level and in the aggregate level. And what is kind of important is that it's a time series story. So we are not worried really much about the fact that this is not an anonymous market, because the way we think about this is that the same client is sometimes informed, sometimes uninformed. And the dealer don't know that which of these cases are happening right now, and indeed probably what is behind this kind of increasing connection is that the client is kind of protecting his own dealer, the one which he has reputation with stretching out his trades across many dealers. Having said that, the reason why we don't really talk about this relationship and that how this whole plays out, that who is actually losing, who is actually winning, is that we don't have too much evidence on that. So we kind of like try to establish that with hard evidence. We don't really see this clear pattern that always your own dealer is losing less and the others are losing more. I guess
that was 2 of your 4 minutes, Peter. Sorry.
Very good. So I will give Gabor has some interesting thought about 2020. So I will let him to answer that question.
2020. Do I? 2020. Okay. So going backwards, then yeah, Hyun questions about balance sheet constraints. So yeah. So we did revisit the 2020 period as well, because we know that there was a huge selling pressure, which probably concentrated what we're picking up the sophisticated clients, because BlackRock, so these asset managers and hedge funds are in our group, which is driving the story. So what we find in 2020, it could well be that there was some selling pressure driving the connection performance relationship, but we do a further split. We distinguish between those asset managers that were under severe selling pressure or balance sheet constraints and the other asset managers who were not. And we still find similar relationship between performance and connection. And the performance connection relationship was particularly strong around 4 or 5 days leading up to the Fed announcements in March, end of March, and the Bank of England announcements. So there was a huge increase. So some of these sophisticated clients were clearly trading before the announcements came. So, but yeah, we do try to control for these sort of selling pressures in that period. Going back to the Chinese wall, going backwards, yeah, question about how the leakage is taking place. Yeah, you have a fair point. There are lots of legal barriers to do this, but when we talk to practitioners, a trader working in Goldman Sachs, one natural source or commonality between the information the dealer and the Goldman asset managers might have is, let's say, the economics department. So I was asking exactly the same question about Chinese wall to to the Goldman Economist, and he said the whole department is writing these reports, which is disseminated both to the dealer and to the asset manager branch. So there's a common source of information, going back to, I think, Andreas's question, that could generate this sort of leakage. Going back to Dimitri's question about reputation, yeah, Peter already answered some of it, and we indeed find that the split in performance seems to be there both on the new connection and the existing dealer connection. So using the terminology of Norman, I think, yeah, some of the existing dealers are being screwed over, if you will, but it could be because they're learning. So as you said, yeah, so yeah, we did that kind of split as well. But yeah, given I'm running out of time,
let me add one more thing. I forgot about this. It was a very interesting question about, Norman, that how the OTC markets differ from the stock, the dealer, the stock market. And we had little about it because we kind of like work only on the OTC side, but our thoughts are that the nature of trade might actually decide whether you want to split over time or over dealers. So what I'm thinking of is that when you have a strategy which has many legs, for instance, in the treasury markets, where you are kind of buying short, selling long, and basically your whole strategy consists of a number of legs, that's where probably it makes sense to split over dealers. When you pick one stock and your information about one single stock, then probably it doesn't. Then what you want to do probably is to do like small trades with a given dealer, because you want to hide that you are kind of buying up large quantities of that single stock. So it might be that there is a logic like that, but we don't have evidence on that. It's really just kind of speculation.
Well, could I thank Peter and Gabor and Norman and Peter for a wonderful start to the conference, and move on, please, to the next paper. Dmitry Orlov, presenting a joint paper with Ron Keneal. Thank you.
Thank you, John. And if I could be able to share my, there you go. Thank you. Can you see my screen? Fairly excellent. Thank you, John, for sharing. Thank you to the organizers for including this paper in the program. This is a joint work with Ron Keneal, who is in the audience. I will not be able to monitor the chat during my talk, so John, I'll kind of defer to you if any questions arise along the way. So this work came around from the following observation, that many provisions of skilled services happen to be intermediated, and I'll give some more specific examples in a second. But the organizational structure seems to be that clients contract with some form of labor intermediary who collects the revenues from clients. Then the intermediary subcontracts an agent, privately subcontracts, and then the agent delivers attributable services to clients, meaning that the clients know full well that it's the agent, not the intermediary, working for them. Now, this project started with us thinking about a fund family like Fidelity employing money managers. In these situations, clients pay fees to the fund family, while the fund family or fund advisors hire a specific asset manager and compensate them privately. So this compensation structure that we see kind of here in red is not observed by the outside clients, who have to make inferences of kind of what is in the best for the intermediary. Now, as we were working on this, we realized this is actually quite prevalent in industries that have kind of a important skill components, such as investment banking, legal practice, consulting firms, and even accounting firms. Now, in all of these examples, we have the situation where all parties learn about the ability of a specific agent, think about it as an asset manager, from the services, i.e. returns that he has provided. However, because skill is important, in many of these situations, it's also very likely the case that the intermediary is better informed about the agent in structuring the compensation plan in order to strategically retain the agent. Now, in this environment of limited transparency, we want to ask the question is, what is best for the intermediary? What is best for the intermediary when basically the objective is to maximize the net between the revenues of the clients and the compensation between the agent. We are going to start with a fairly simple benchmark where the disciplining mechanism of the intermediary when setting compensation is the agent's ability to contract directly with clients. This is fairly reasonable because in the sense of in fund management, the agent can go and open a hedge fund by raising capital. When we think about investment banks, consulting, or legal practice, we can think about the agent going working in-house for clients. And it's not prohibitively costly to open a private accounting practice either. So this possibility of contracting directly with clients would allow the agent to directly exploit the market reputation that they have accumulated and serves as a disciplining mechanism for the intermediary's compensation choices. Now, we can allow for lateral moves where there's competition across intermediaries for the agent's skill, but that turns out to just give the agent a bit more bargaining power, and it's not going to be the main focus of the topic. Now, the key observation that we're going to base our analysis is that the intermediary benefits from high revenues, but low compensation cost. So if the agent is highly skilled and has a lot of generates a lot of revenues, well, that doesn't make much good for the intermediary. He demands a lot of compensation as well. And this is kind of the starting point, that in this context, the agent is ever going to let go, not because they are unskilled in providing services for the clients, but they develop too much of a bargaining stance with the intermediary relative to their skill. Now, this information revelation is going to occur both exogenously because of the performance signals that the agent generates, but also endogenously based on the decisions chosen by the intermediary in terms of hiring and retention. Now, all parties in this environment, kind of if we think about starting with an untested agent, say a young fund manager, then everyone is going to be learning from his returns and performance over time. But at the same time, by nature of how the agent proceeds into these professions, there's a bit more information that the intermediary knows about the agent than the client. So when there is a lot of informational asymmetry, then the agent effectively suffers a large adverse selection in their own labor market. So if the agent were to leave and if an unproven agent tries to leave and start his own practice, well, the clients may be suspicious. This leads to a kind of an adverse selection penalty suffered by the agent were he to leave the intermediary early, allowing the intermediary to effectively expropriate the agent regardless of skill. So the agent in this kind of initial phase, if you think of the game, when the agent is unproven, is going to be undercompensated regardless of the skill. So the intermediary has a lot of bargaining stance here. However, as the agent generates performance, this information wedge is going to shrink. And eventually, it's going to basically collapse this intermediary's initial informational advantage, in which case retaining all agents is no longer profitable, and the intermediary endogenously speeds up information revelation by churning lower skilled agents. So this further reduces the informational advantage, but it comes with kind of a hidden benefit for the intermediary because now high-skilled agents are willing to pay for this reputation-building service of being kind of separated from lower-skilled agents while being employed for the intermediary. So in other words, being employed by the intermediary serves as a credible way to build reputation by the agent and extract the value added of a skill in the future from clients. Now, this work is related to a broad literature on recent work on finance and the labor markets with asymmetric information frictions, recent work on adverse selection and signaling, as well as career concerns. Perhaps surprisingly, when it comes to labor markets with asymmetric frictions, information frictions, the most related paper is Bruce Greenwald's 1986 restud, which we kind of, which is related to our work, will be substantially extended. So let me talk you through the building blocks of the model. The intermediary, there's one intermediary, employs at most one agent at a given time. And we think about the intermediary providing a particular kind of service, say offering a particular fund to the investors. And there's one agent managing it at any given point in time, but if an agent leaves, the intermediary can hire a new one. So for the given agent, the intermediary knows more than clients. We assume that this happens at the start of the relationship. The intermediary sets private compensation for the agent. Now, private compensation helps the intermediary discriminate based on the private information about the agent. The agent is let go at an observable time tau. This is just notation. And it's costly to find a new agent, meaning that there is a fixed cost and a delay cost. One of them should be positive. And this is to prevent the intermediary from scrolling through the agents just at an infinite pace. Now, each agent can work for the intermediary, open his own firm, or leave the industry. Now, we allow later in the paper for the possibility of lateral moves, but as I said earlier, this just changes the bargaining power of the agent, so we do not focus on that yet here. Now, the agent has a binary ability theta, 0 or 1, capturing kind of the latent quality of his services. This is kind of for exposition. We have a much richer model in the following sections of the paper, but this will get us about 80% there. Now, without loss, we're going to also assume that contracting directly with clients is costless for the agent, meaning that the cost of starting their own practice or moving in-house is not prohibitively costly. If it was costly, then this would not change our analysis, and so we do this for contrast, if you will. And finally, the agent's outside option of leading the industry is normalized to a constant, and all we need from that is it to be less sensitive to the agent's skill within industry. So in other words, the agent's skill becomes less relevant when the agent leaves. Finally, the client's demand for services, we assume, is going to be an increasing function of the perceived quality of the services. So the clients indeed are the residual claimants of the agent's skill, and we just write kind of a combine. We combine the quantity of the services offered by the agent and the price into just a single revenue function, A of expected value theta at a given time. Now, this is kind of informed, and we kind of in the back of our mind think about the money management example, where we have a mutual fund which collects a percentage on assets under management. Under decreasing returns to scale, assets under management are pinned down by the perceived ability of the manager to generate alpha. And so assets under management are an increasing function of the skill. And so the intermediary's revenue or the agent's revenue is just fee multiplied by kind of the inverse of the market impact function. Now, we assume that A is the same whether the agent works for clients or works for the intermediary. This does not have large implications on the analysis. We can also introduce a performance-sensitive components that, in the absence of the explicit moral hazard, this does not change the analysis either. So let's talk about the information structure in this environment. When the agent is hired, the intermediary and the agent observe an imperfect private signal about the binary outcome theta. So even though the agent's skill is 0 or 1, we identify the private information with a private ex-ante belief P0, which we assume is continuously distributed. So even though there is private binary latent types, the private information is continuous, and that generates a smooth path of wages. Now, in the baseline version of the model, we assume that performance follows this simple Poisson process where a high-skilled agent, a theta equals 1 agent, generates good performance in perpetuity, while a low-skilled theta equals to 0 agent generates a Poisson shock with an arrival intensity lambda. So basically, this arrival intensity lambda makes it less valuable for the investors for the clients to procure services of this agent, and so that decreases the revenues. However, it's important, the perception is the thing that's important. Now, all parties here, the intermediary, the agent, and clients, learn from performance, and in this kind of simple learning environment, as long as the agent doesn't generate any kind of negative Poisson shocks, beliefs gradually increase. So as long as the agent generates good performance, everyone becomes more optimistic about the quality of the agent. However, when the agent does generate when the Poisson process does generate an arrival, then the agent is revealed to be unskilled, both in the eyes of the clients and the intermediary. Now, importantly, because private information P0 is not observable by the clients, and so they have to basically learn from performance and retention. So the way you want to think about this is that PT is going to be gradually revealed via both performance and how long the agent has worked for the intermediary. Now, in order to specify the equilibrium, let's kind of talk through the two levels of reputation that are relevant for the agent. We're going to start with a slightly more complicated one. So first, we need to, when we think about the intermediary setting compensation, the agent's outside option matters. But that's determined by the agent's ability to extract value for his services when contracting directly with clients. And that means figuring out what belief the clients assign to the agent who wants to contract with clients directly at time T. In other words, KT is the belief about the agent who leaves the intermediary at time T. We assume in the baseline version of the model that the clients only learn from performance once the agent opens his own firm, but that can be relaxed to allow more flexible signaling as well. We have conditions under which this is not this leads to a qualitatively similar equilibrium. Now, KT is basically an off-path belief, on-path and off-path belief that the clients assign to the agent, and that determines the value that the agent can claim by opening the firm at time T, on-path and off-path. So U of PT-KT is the expected value of the agent of collecting revenues for his skill up until the arrival of a negative Poisson shock. So if the agent is skilled, he's going to collect increasing revenues in perpetuity. If the agent is unskilled, eventually a Poisson shock arrives, forcing the agent out of the industry by basically assuming that L is big enough that it's better for unskilled agents to leave. It's a simple parametric assumption. Finally, once we've defined kind of which agents stay and which agents leave, I'm going to mention one more thing, is that in equilibrium, and this is kind of a unique equilibrium within a fairly large class, very large class in fact, KT is the lowest type of agent still employed on path, which means that the client's belief about the agents who stay is the average of the agents that are weakly better than this cutoff type KT. So QT here is the belief about how skilled the agent is, conditional on the private information PT about this agent being greater than this cutoff type KT. So with all this notation, this is almost all the notation that we'll need in the paper. And the adverse selection that is relevant, the kind of the measure of asymmetric information that's relevant in this paper, is the difference between the average type, or how much the intermediary can collect for the agent services, minus this cutoff type is how much basically the agent can collect on his services were he to try to sell them independently. Now, the equilibrium is going to be an observable stopping time tau when the agent is let go. Type-specific wage processes WT. For each type, there could be a different wage process that the clients do not observe. And belief processes QT and KT. Now, the optimality, the intermediary's optimality is that it's optimal to kind of retain and compensate the agent until time tau. And then when the agent leaves, the intermediary hires a new agent, and that's this intermediary's continuation value V. Subgame perfection here is captured very neatly in that the retention constraint is going to be binding in every history, meaning that the intermediary is going to basically try to pay as little to the agent as possible as to prevent the agent from leaving before the turnover time tau. Now, the intermediary's continuation value is very important here because letting go of a given agent is only valuable to the extent that the intermediary can replace that agent. So this replacement value is going to be defined as a fixed point of hiring a new agent in the future and repeating that game again. So here is the time delay cost delta and fixed cost I of hiring a new agent. And finally, we have the belief consistency that KT and QT processes are consistent with the turnover time. Now, with this in mind, let's characterize this turnover process. Suppose that the profit wedge is high. Now, when we say about the profit wedge is high, it's just suppose that the revenues, A of QT, that the intermediary can collect, exceed the revenues that the agent could collect in that instance where he tried to contract directly with clients, exceeds the flow opportunity cost for the intermediary of hiring a new agent. Now, this, of course, happens when there is a bigger difference between QT and KT. And so in this situation, the intermediary can pay all agents their reservation wage A of KT, basically to match the client's outside offer in that given instance. And that is profitable because capturing this profit wedge is better than kind of delaying resampling the agent for a short period. Now, when the client's beliefs are dispersed, there's more likely to be a difference between QT and KT, and hence, even once we put the revenue function on top of that, this is still going to be significant. Now, the problem with this kind of with such a compensation structure is over time, beliefs converge. So beliefs converge either because a Poisson signal arrives and destroys the informational advantage altogether, or even as beliefs increase gradually upon good performance, KT is going to approach QT eventually. And so this condition is eventually going to be broken because performance gradually reveals agent skill. As a result, even though the revenue A of QT can increase upon good performance, the same cannot be said about the intermediary's profits because those are a wedge between Q and K. Now, when this profit wedge is lower than the opportunity cost, then retaining all agents becomes unprofitable. And in this case, the intermediary is going to start churning lower skilled agents, and it's going to do so by basically firing lower skilled agents at a certain equilibrium rate, which we need to determine. And we denote this rate by gamma that depends on time and the current cutoff type. Now, as this happens, basically the cutoff type starts speeding up towards the average type because the information asymmetry shrinks even faster as the churning now happens. However, agents are long-lived, so they value the gains in reputation that they could claim by staying with the intermediary as the intermediary churns lower skilled agents. So being separated, being distinguished from lower skilled agents is valuable for higher skilled agents, and agents who are willing to stay with the intermediary are willing to get underpaid relative to their reservation wage by the amount of reputation building gamma multiplied by the marginal value of their reputation, which is just the second derivative of U with respect to K. Now, this selective retention by the intermediary is a credible signal to the market, and higher skilled agents are willing to pay for it. What's important is that higher skilled agents are willing to pay more for these signals than lower skilled agents, and that generates the agent single crossing. And that's even though good reputation leads to more assets under management for any manager, because more assets today means more revenues today. Higher skilled agents expect to stay in the industry for longer because they expect to generate this good performance for longer. When we say higher skilled, on the margin, agents who are more optimistic about their skill have longer term expectations in the industry. And so a little bit more assets today translates to a little bit more assets for a longer period of time. And so they value this reputation more. And as a result, the churning rate, the rate at which the intermediary has to let go of lower skilled agents, is determined by the marginal profitability of the worst agent remaining, because that's the agent who's willing to pay the least for this reputation building opportunity that the intermediary provides. And so this pins down the churning rate in kind of a forward-looking way. So the constructing the equilibrium here is very easy because we kind of have to, we can often solve it forward. In many cases,
Dimitri, I'm going to finish in about 5 minutes max, please.
Perfect, thank you. Now, in many cases, the churning set is just going to be an interval, so there's going to be a quiet period followed by a churning period. Now, if we think about the agent's wage, here's how this looks. Between 0 and T star, the agent's wage is just going to be determined by his reservation wage A of KT. Now, in black here is the intermediary's revenue. On the x-axis is just time, and on the y-axis is basically revenues. Now, as the agent's wage, due to public performance, converges to the intermediary's revenue and becomes sufficiently close to it, then the intermediary begins to churn lower skilled agents. As the intermediary starts to do that, the reputation building element of reputation building benefit from churning lower skilled agents means that the wage paid to the agent is actually starting to decline, with the red part, with the red part of the graph highlighting the pay for reputation amount that the agent conducts. Now, from the perspective of the intermediaries' revenues, flip side of that is that they decline during the quiet period when there is no churning. However, when the marginal profitability of the intermediary is sufficiently compressed and churning begins, all of a sudden retaining higher skilled agents becomes profitable again. So in other words, during the churning phase, if you are employing a high skilled agent, then your profits will be non-monotone, and they will be non-monotone up until your really high skilled agents becomes, in the pool of retained agents, not so highly skilled relative to the ones that you have retained. Now, with this equilibrium in mind, what we still need to determine is the intermediary's equilibrium value V from playing this game with a sequence of agents. So V is basically the expected value of hiring a new agent, then letting them go at the equilibrium time described earlier, and hiring a new agent at that. So interestingly enough, here the solution to this fixed point equation, and this is kind of a tough fixed point equation, is not always unique. It's unique under large kind of resampling cost, but you could also have self-reinforcing reputation bubbles where kind of a high V translates to a lot of turnover, fast reputation building, and fast churn, and that in turn generates a high V again. But still, the intermediary, what's important for the paper and what I want to kind of convey here is that the intermediary profits from the informational advantage about the managers, not so much from the average quality of these managers. Now, to capture this, let's consider the intermediaries' profits that come from reputation building relative to the overall profits. So we're going to basically measure the percent of pay for reputation that the intermediary can keep relative to the overall profits that they can keep. And what we see here as kind of the first comparative static as a function of the difference between the average quality on the x-axis and the lowest initial quality P lower bar, we see here that as this difference increases, the intermediary's profitability V in blue increases. However, the pay for reputation dynamics in red, they're maximized for an interior value. And the reason is that when there is not enough informational asymmetry, then it's really unprofitable to hire new agents, so the incentives to resample are low. When this is, on the other hand, very large, then it takes so long to converge to this churning region that, again, you're not really spending that much time there relative to the expropriation phase. And this can also be seen from the start and end of the churning region, which for the sake of time, I won't cover. The same plots, or qualitatively same plots, also apply when we talk about the persistence of the information signals measured by the arrival intensity of Poisson shock lambda. The profits of the intermediary increase as the lambda decreases, and it's maximized for an interior value as well. Same goes for the start and end of the churning region. Now I'm going to mention very quickly the various robustness and extensions that we have also considered. So we can allow the agent to independently signal his quality by using a fee for his services or discount on his services when he contracts directly with clients, pay for reputation dynamics whole. We can think about this reputation building as a form of general training that the intermediary provides to the agents. We can show that these are very distinct from the existing arguments in the labor literature, because the general training is generally profitable in the quiet period when there's a lot of informational asymmetry about the agent and the expected retention is a long period of time. While reputation building occurs exactly when the turnover is more likely. We can also talk about competition for agents. That kind of serves the purpose of introducing bargaining power to the agent, which can have somewhat ambiguous effects on V and the overall churning rate. Finally, we kind of also analyze a very rich Brownian model of performance signals, motivated to some extent by our mutual fund intuitions. So we construct a Brownian a conditionally normal Brownian model where the performance follows a conditionally normal filter, where when I say conditionally normal is that the priors about theta are not normally distributed, meaning that from the perspective of the intermediary and the clients, this is all a linear normal filter. From the perspective of the intermediary and the agent, it's a normal filter. From the perspective of clients, it's a very non-linear filter, but still all of our results hold. The novelties, you can have multiple churning regions depending on the specific paths of performance. Interestingly enough, profit wedge and asymmetric information increase in performance and increase in good performance, but decrease if the agent generates bad performance. And so the intuition that kind of I take from this is basically surviving a crisis with the intermediary is a good signal going forward. So to conclude, kind of we think about this as a theory of employment contracts under dynamic asymmetric information and without commitment. At no point in the paper do we rely on the ability of the intermediary to commit to long-term compensation, with the agent's reputation serving as kind of deferred compensation pool. And the intermediary profits from having expertise in evaluating agent skill, where in high asymmetric information environments, there's a possibility for expropriation, while in low asymmetric information environments, the intermediary speeds up information revelation, and that also turns out to be profitable. Thank you very much, and thank you to James for agreeing to discuss our paper. We look forward to your comments.
Well, thank you, Dimitri, for talking to James for the discussion. It's good to see you, James.
And you, John.
We could just look at your face. That will do.
Actually, it would do. But one of my slides I would like you to see. So here we go. I think you can see my slide now. Good. So, right. It was a pleasure to be asked to discuss this paper and to hear Dimitri's presentation as well, and to be part of this conference in these difficult times. Okay, so the question the paper asks is what kind of configuration we're going to see. Will we see the ultimate clients contracting with an intermediary who hires workers, or will we see clients contracting directly with workers? We have one client, one intermediary, and one worker taken from a pool of workers. Okay, so we're suggested that the client could be someone who wants to invest money. The intermediary could be the fund management company, and the worker could be the individual fund manager, person who works as a fund manager or team of people. Okay, the worker observes their own skill, but not perfectly, with noise. And the intermediary that employs them also immediately learns the same thing. But importantly, the client does not learn that. On the other hand, there's a public signal that all of them get every period. So even the worker and the intermediary will learn more about their skill from this signal. And obviously the client will start learning too. So you can think of that as the result that the funds under management achieve each year. Okay, the public nature of the signal, I think, is a distinctive feature of the paper. Actually, I'll comment on this later. The paper doesn't talk very much about interactions between different clients and different intermediaries. The worker's also distinctive is that the worker's productivity is of direct benefit to the client and is not of direct benefit to the intermediary, although it might be of indirect benefit to the intermediary because the intermediary who has good workers, or sorry, who has a good worker, could maybe charge more to clients in the future. So client equals investor, intermediary the fund management firm, worker is the individual fund manager. And I would say not most employment at all, because very often in most employment, the output of the worker goes to the intermediary, and the intermediary benefits directly and could then sell that to the client. I would be interested if Dimitri thinks that's the wrong interpretation, because certainly in the paper they give some other examples of employment contracts that that I didn't agree fit into their framework. So I would say, for example, if you're a hospital employing an agency to find you nurses, if the nurses do a good job, that directly benefits the hospital. It doesn't benefit the intermediary, the employment agency. Okay, result. There are lots of results in the paper, but I think the main results that are stressed is about churning or firing workers, worker turnover. And obviously this varies in the cross-section. That's not a big deal, but it varies over time. There are periods where there's lots of churning and not so much churning. So I would say the churning in the time series is the main feature of the paper. I will give a little idea to show you where I'm coming from, and this may seem a bit high level and vague, but actually I will make it precise. So I'd like to give you another example from another field. I wanted to find out about cardiology a few years ago, and I bought this book, which I recommend to anybody who's interested. It's called Life-Saving Answers Ignored by the Medical Establishment, which is an unfortunate title. You might think it's telling you to drink bleach and you'll feel okay, but that's not the case. This is written by a very good researcher, and he's got a great perspective, which really changed the way I thought about research. Because in this book, as a very distinguished surgeon and researcher himself, he eventually reached a point, I think, where he's really trying to understand what we know about the whole system. And he's looking at individual research projects in terms of what they add to our overall knowledge. And he has specifically in cardiology, the people who do the plumbing and the people who do the electrics don't share much knowledge. And he points out a lot of cases where the plumbers and the electricians of the heart, don't understand important problems because of that. I now tend to view research in terms of how it adds to my map of the economy and the economic system and how it all works. If I was a European in the 17th century, my understanding of North American geography might look like this. And you can see I would know a lot about the East Coast. I would have a detailed picture of California, although it seems I thought it was an island, so that was wrong. And in the middle there, I didn't know much at all. We obviously need to fill in what's going on in the middle, where they just said it's a tract of land full of wild bulls. So some interesting questions of gender identity, but although I'm sure it was true, there seemed to me to be some mountains missing from this picture, this blank bit where this tract of land. Okay, so what I want to do increasingly over time, I like to understand research in terms of not the individual paper, but how it helps me to fill in gaps on the map, possibly correcting mistakes along the way. Okay, so in theory research, I tend to class papers into three types: intuitive stories, exploratory, by which I mean papers that do exactly what I just said, and results-driven papers. And obviously, all three of these could be good, but I tend to be a little bit biased against intuitive stories, mostly because intuition is used very loosely by many people. Exploratory, I love. And results-driven, I also like, of course, so long as we have strong results. But I really think that exploratory type of research and that way to present research is underappreciated in our profession. Now, coming back to the model, and I'll return to the question of exploratory in a minute. There are two versions of the model: the simple or Poisson version and the richer version. The authors in the paper and in the presentation give most attention to the Poisson version, and just mention the other one more as a robustness check. At least that's the way it comes across in the written paper. So there's one intermediary, one client, one agent who's taken from a pool. The agent has to start with an intermediary, but then can leave off and go somewhere else, working independently, not working elsewhere, I think. So I would be very interested in finding out more about dynamics of different intermediaries and different clients who are obviously then would change the outside option of the worker, because the outside option is going back into the pool or working independently, sorry, or leaving the industry. Okay, intermediary can replace the agent at cost and makes a take it or leave it offer to the agent. The intermediary can train the agent. So there's a lot going on. Equilibrium definition is a stopping time for the intermediary to fire the agent, and a wage offer, which is a function of time and beliefs, and subject to the constraint that the worker doesn't want to quit. question I've highlighted there, stopping time. I wasn't sure if that was a restriction on the strategy, or is it an assumption about the kind of equilibrium that they want to look at, or is it a result? It's not a result, actually. So is it a restriction on the strategy, or is it a restriction on the kind of equilibrium they want to study, given that agents could deviate by using broader, from a bigger set of strategies? So I'd like to really know what the set of strategies is, which the game theorist in me would like to know that. Okay, results, lots of results, but I think the main ones predict how turnover changes over time. Okay, related literature, lots of different areas relate to this paper. Asymmetric information in labour markets and reputation in labour markets, building up over time, dynamic signalling games, incentives to train employees, and also the authors say new methodology for solving dynamic adverse selection. Results, they characterize the equilibrium, and they show that there are quiet periods contrasted with periods when there's a lot of turnover. Okay, now here's a summary of my main questions and things I'd like to know and comments. Okay, viewing it as an exploratory paper, a paper that fills in the gap on the map where there are just herds of wild bulls, I'd like a little more focus on the main results. Even though this isn't primarily a results-driven paper, it's not a paper that tries to derive one result and then prove it. It is a paper that explores what's going on. I'd still like a little more focus on main results, explain how they differ from previous literature, previous models in the literature, why other assumptions can't give these results. It's not an empirical paper, but is it actually true that there are churning periods of high turnover and non-turnover periods in an individual worker's career? So there must be data on that. So let's see what it is. I'd like to see more. I think if I'm right, we need to see more of an emphasis on the career. The time period here is the career time, not the time of the whole economy. So it should be that as you progress through your career, that's the time scale we're looking at here. Now, comparing the model to other nearby geographically close parts of the map, comparing it with a suitable reference point. Okay, I'm not sure how this model would handle multiple clients, or how the authors would want to approach that. But I guess one question would be the signal that there's sort of productivity they're looking at could be private to the client, intermediary, worker trio, or it could be public to other potential clients and potential intermediaries who might employ the worker. I'm not sure how this model would handle multiple clients. What about the same model, another suitable reference point? What about the same model, but output goes to the intermediary? So here the output goes to the client. The intermediary, if he's got a higher, if they've got a high output worker, they can charge more fees maybe, but the direct effect is to the client. Does that make a difference? What difference does it make? And I think that, so I think that's important, because that's what makes this model distinctively a model of fund management in particular, which I guess was the intended application. Obviously, I'd like to know the benchmark for efficiency. So what, if we think about efficiency, what could a suitably informed planner do with suitable assumptions about what tools they could have? What is the difference in outcome to what we see here? And then, since the paper is a paper in dynamic adverse selection, and frankly, I don't really know that area as well as I should. So could we have a little bit of guidance, or, what are the open problems in that area? Which ones does this paper answer? That might seem as if I'm asking for a lot. I'm not really asking for the paper to solve a gigantic open problem in dynamic adverse selection, because it's already doing a great deal already, but just a little bit of guidance on what are the key areas where these models are tricky, and where do some of the things developed in this paper help us to think about those issues. Thank you.
Thank you, James. So open for questions. There's none in the chat right now, but could I throw in one from the chair, which is, as I understand it, there are two people with private information, the intermediary and the worker, and of course the client would like to know that private information, and actually so would the two of them as well. So what would be, it's related to James's question about planners, but sort of perhaps more narrowly, which is what is the optimal contract? Bearing in mind you could have presumably simultaneous revelations about these pieces of information. If they both know exactly the same private bit of information, that sort of opens the door to mask-in style mechanisms and all that jazz. So, okay, that's my tuppence worth. Would anyone else like to step in and ask something? Let me hand it back to Dimitri and Ron, if he wants to contribute, to answer James's intriguing observations. I wasn't quite sure, James, about where the heart book fitted into what you said. Can I ask you? It sounded great, but I wasn't quite sure what it was, how it connected to the bulls.
Okay. Yes. Well, okay. The heart thing is what led me to. It's really the same point presented with two different graphics, if you know what I mean.
Okay.
But it is relevant because when you go to the doctor, for example, when you go to hospital, the doctor only sees you at that time, and when that doctor's database of what it constitutes success and failure is only based on whether you walk out of the operating theatre, don't collapse shortly afterwards, and then another doctor might see you for another problem a little while later, and have a different understanding of your problems and not fit them together. So there's not much filling in the gaps of knowledge, either in their training or in the data they collect.
To Dimitri and Ron.
Let me start. James, thank you for your discussion. You kind of help us focus on kind of important points. I have kind of an imperfect list here now that I can see your slides. So let me start with multiple clients. So this is very kind of an interesting point that you raise about kind of the information dynamics with dispersed, say, private or public information. And in some settings, this could be very applicable, such as consulting services, where you can have multiple clients and they could have dispersed information. This is something that kind of, as we were kind of being started thinking more about consulting applications, it seems quite important, something that we may consider doing to the extent that kind of it fits into kind of within the paper land. But we agree with you that this is an interesting question. Right now, my perspective on kind of multiple clients, one client, right now we deal with representative clients in the sense that the information flow is public, and so kind of the demand of multiple clients is aggregated, but that I don't think that kind of answer goes to the heart of your question. When we think about strategy spaces, so the strategies are, as far as I can tell, quite general. So the stopping time is we can think about the stopping time and the equilibrium filtration are kind of one and the same in this context. And so from the perspective of from the perspective of the intermediary and the clients, we think about tau as a stopping time, but that generates kind of an information partition for the clients. And I mean, from the client perspective, it is incrementally informative. When we think about profit sharing between the intermediary and the clients, and maybe kind of mention how this relates into the existing literature and existing questions, I think that the understanding of kind of the dynamic employment relationships under asymmetric information is important and kind of understudied. It's kind of this, maybe this is where the wild bulls roam kind of in the map. And this is something that where we aim to contribute. Now, the closest paper is the Bruce Greenwald's 1986 paper, where the main focus is on this kind of maybe hospital example, if you will. Now, if you told me that the nurses at a given hospital are not doing a great job, I might choose a different hospital. So there is this perception component of quality of services when you do decide. But we can think about a convex combination of who is the residual claimant, and we can kind of attribute this part to clients, part to the intermediary. Right now, we're on the extreme where the clients are the full residual claimants. We can easily relax that. Now, what happens with the equilibrium in the equilibrium is just the churning set expands and the quiet period shrinks a little bit. But this is from the analysis that we've done, kind of the back end of the envelope analysis, the qualitative properties of the equilibrium remain the same, while we would need to reevaluate the comparative static results that we've obtained. But my intuition is that it would be quite similar. The planner's problem, and this relates to your question and John's question, is very interesting. It's very interesting because you are right. You're completely right that as you have two parties with kind of private information that's shared, you could have a kind of a complicated. You could have a mechanism that tries to elicit this information. It's a very hard problem in this environment. Not only because of the kind of the specific payouts, but also because of the sequence of agents. So kind of this mechanism needs to attribute enough rents for the intermediary to make the continuation value reasonably high, to kind of because it features in the current incentive constraint. What we haven't done yet, and what I think would be interesting to do, and I'm not sure that, but I'm not sure that we will do in the current version, is to potentially allow for heterogeneous signals between of quality between the intermediary and the client. That's what kind of help alleviate to a bit this kind of very general mechanism design problem. Now, what we can do, and this is something.
The only thing, Dimitri, as I understand it, you're working with a world with no long-term contracts.
Right.
So that is, both a very strong assumption, of course, but it also is wonderfully clarifying. It may actually have all sorts of interesting classic revelation-style mechanisms. You've got to do everything within the period, as I understood it.
Yes. Thank you very much, John. Yes, I mean what we are doing right now, and something that we've kind of where we have gotten a bit more kind of distinct clarity is if the agent could signal his own skill via kind of a contract via a sequence of contracts without commitment. And what we've discovered is the agent can do quite a bit via that, even without commitment. However, the intermediary, by virtue of having this additional continuation value of sampling a new agent, is actually able to exceed the rate of reputation building that the agent can do on his own, even with kind of a flexible contract with commitment, or in fact without, because certain reputation dynamics can support kind of the equivalent of a long-term contract from the perspective of the agent. But your point is absolutely well taken, and really great comments. I hope Ron, would you like to add?
Yeah, why don't I just comment on a couple of quick points. Well, first, thanks James for the comments. We appreciate them. First, I want to sort of touch on this example with the nurses. So first, I agree that this model doesn't fit the nurses. Where I disagree with you is that you said that you think it doesn't fit the examples, or at least a subset of the examples that we have in the paper. I think what's important for the model is that we're thinking about settings where the quality is actually attributable to the agent. Now, I think in a doctor or in a hospital setting, the quality when there's an operation is attributable to the surgeon. It's not attributable to the nurse. If you're a NASA engineer, even though you might be contributing a lot to the project, the outside doesn't sort of perceive and doesn't understand what your contribution is to the system. In many of these settings that we're thinking of, and mutual fund managers is a good example, the key is that the outside, when they observe the performance, they attribute that performance to that agent. And that agent also has the ability to essentially go and open his or her own firm to generate these services. And the second important thing is, of course, that you need to observe them at a fairly high frequency. If you don't observe them at a high frequency, you're not sort of learning throughout. So I think that's very important. And in some of these settings, for example, like when you're a lawyer, you work, people see how well you've done on cases. They don't attribute the skill to the paralegal that helped you, but they do attribute a part of the skill to you. Now, I agree that there's a skill also of the intermediary, and that's something that we decided to abstract from this in this model. So in reality, there's, the agent contributes something, the intermediary also has some contribution, but we're really trying to focus on the agent. The other small point that I just want to point out is that at some point you said that the agent, when they start to work, they have to start to work with the intermediary. We allow them to start to actually work alone. They're allowed to sort of start off on their own, but what we show is that that's actually suboptimal for them. So one result, which I think is actually quite important, is that the agent will always want to start to work with the intermediary because that's a better signaling mechanism for that agent to reveal his quality due to this churning phase where he stays, the good ones stay, the ones that are not as good depart.
Okay, so Dimitri, you're absolutely right about the strategies. I take that point. In terms of what kind of situations are represented by this model, I think we both agree, we all three agree, the model is about one worker. So if there's a team of workers, that's a different thing. I didn't really mean that. What I meant is, sometimes the output of the worker goes to the employer, sometimes it goes to the client. Now, Dimitri, I think you said that intuitively it doesn't make any difference and your results would work for both cases. In which case, well, that's great, but I don't think, I wasn't meaning that it had to work for both cases. I was actually thinking that you were saying it was going to be different in both cases, and that was one of your points. But either way, it would be nice to know whether it makes a difference to the results, whether the output goes to the intermediary or goes to the final client. And Ron, I don't really have a view on which one is the right model. I would like to know how this assumption affects the results. And I also think your point about what an agent does at the start of the career, I think it's interesting. You don't cast the model very much in terms of career progression, but I think there is potential for you to explain it more in terms of career progression and I hate to say this, but potentially match it up to some data on what fund managers do over the course of their career. But I know it's not I hate it when people try to hijack my theory papers with unnecessary facts.
I definitely agree that this is a paper about the career of the manager, and I think that's a very important point. And it seems that is not, at least when you read it, that didn't sort of come out of the paper, but that is what we are thinking about.
I think we're in danger of encroaching on people's lunches, and that's a crime against humanity. So could I say thank you to both sets of speakers and both discussants for a cracking good session. Thank you very much indeed. We'll meet again at.
I hope you had a good lunch, although different lunches as opposed to the normal lunch that we would all have together. I have been asked to remind everyone of the rules of the game. So time allocation, 25 minutes to the speaker, 15 minutes to the discussant, and hopefully then we'll have 10 minutes for Q&A. So please stick as closely as possible to the time. I will remind you, I don't know whether you can see this, but I will remind you of how much time you have left during your presentation. If I see that you're not seeing the board, I will just say it aloud. Please mute the microphone unless you are speaking. As regards asking questions for the panelists, just raise your hand. For the attendees, use the chat function and send a message to everyone. We will have a 30-minute break after the first paper, and then a 5-minute technical break after the second. So without any further ado, the first paper is entitled Pledgeability and Asset Prices, Evidence from the Chinese Corporate Bond Markets. And it's multi-authored, and don't ask me to pronounce all the names, but the author who will be presenting the paper is Ji Guo Hui, and the discussant will then be Dora Xia from the BIS. Jingguo, the floor is yours.
Thanks a lot for the organizers to present this paper. Was scheduled a long time ago, I remember. Eventually it's happening. This is a paper together with a bunch of co-authors. Chen Zhuo, I believe, is here today. The motivation is fairly simple. We know that the pledgeability, or using the assets as a collateral to borrow, will allow people to unleash their willingness to pay or other financial constraints, releasing the financial constraints, so that the asset pledgeability is a very important part of the so-called liquidity. The typical problem of try to get how the quantitative question of how big this effect could be is really brought into this identification challenge, because the pledgeability typically endogenously linked to fundamentals. Okay, so usually the way that we think about pledgeability is using the word called a haircut. So asset market value is $1, then let's say that exogenously haircut is 1 minus H. And then obviously, if you vary H, you can figure out what's the endogenous market price reacting to H. But unfortunately, that typically H going to be endogenous. So usually is if you have a asset that really volatile, then the H is high, vice versa. Okay, so those things just impose a very big identification challenge. That's why that in the literature, there are a lot of attempts in the past. I do not think that we kind of like have a classical paper saying this is the number and this is the way how to do it. We use the Chinese bond markets to answer this question. We tried our best. It's very close to the truth, even though that there's still a little glitch that we need to put a 2 pounds on it. So let me just explain to you the unique institutional features that allow us to do this, to perform this exercise. Mainly, we are utilizing the fact that in China there are two well-developed but segmented markets for the same bonds, called exchange markets. The other is called interbank markets. I'm going to spend some time to explain to you the difference, but basically 2 markets. And they have different rules for repo. So that basically give you the sense that you have the same guy with the same fundamental, but the H policy is different, so that we can figure out the impact. We also use the unexpected policy shock for the pledge on one of the markets, which is the exchange markets. So you can see that it's we already have this 3-diff structure that for us to basically to design a empirical setting so that we can figure out how big is the H effect. Okay, so here's the overview of the results as quick as possible. So there's in 2014, December 8, exchanges suspended the repo eligibility for all so-called enterprise bonds. You can ignore all these enterprise bonds, just bonds rated below AAA. Although obviously for our identification, these details matters, but it's just that given the time constraint, I would not expect it. So basically, there's a bunch of bonds that are dual listed on two markets. Exchange all of a sudden slashed all the pledgeability. Okay, what's interesting is that they slashed the middle groups of the bonds, the haircut rise to 1 or pledgeability goes down to 0. Okay, what's left that are not touched is AAA, the upper guy, or the AA minus guy, because AA minus guy was cannot be pledged out anyway. So that's why this policy also didn't change it. And this, the policy came as a surprise, and what we show is that from the raw data, you see that a treatment group, the exchange premium, that's the bond market yield spread, and the treatment group of exchange premium goes down, which means that the price of the treatment goes down. So you see that interbank minus exchange yield. So which means that if it's a price, then it's the opposite. So treatment group basically price go down, control group price go up. There's some other time varying treatment. I will show you. So you can see that clearly that the middle group moves different from the upper and the down. So that kind of control is we think it's very unique, because that way that a rule that many alternative story where the shock is related to the fundamental. If that's the thing, then and typically you see the monotone effect. Okay, so that's the part of it. The answer to your original question basically is if I increase the haircut from 0 to 100%, then the if we use the exchange premium, then that's like a 39 basis point. We argue that because of the potential, even though it's a segmented, but there's still a arbitrage possibility, so could be downward biased. We also try another way that I will explain to you, that it's likely to be up biased. So we give a bound on that, 40 basis point versus 85. And these numbers, the truth probably lie in between. Take these numbers compared to the earlier attempts, US EU numbers, it seems to be a little bit higher. We acknowledge that it's very hard to compare these markets, but just to give a sense of the magnitude. Okay, so we also see the quantity. All right, so let me get to the main presentation of the paper. We first gonna explain a little bit to you on this two market structure. So there's one handbook chapter I wrote with Armstead. It's on Chinese bond markets. In China, there are exchange markets, the interbank markets. Nowadays, it's 90% of the market size is on interbank markets. I will explain to you later the difference. For this paper, for today's identification, it's very important to understand that there are some common financial investors that are very active on both small markets. They're security firms or mutual funds, like these are institutional investors. They are allowed to active on both. And as a result, that you can think about it, who are these marginal investors? These are the marginal investors. And if we identify their cost of capital or some preferences from reviewed by the prices, we are talking about these guys. Okay. So these two parallel markets they differ quite a bit in terms of the cash market. When I say cash market, it means that you trade bonds. Okay. For the exchange markets, it's order driven. It's like the stock market. It's stock exchange market. They just created China has the stock exchange market. They just relabeled it into the bond, and it's all order driven. People putting quotes. The trade size is relatively small. It's like a retail part. Trading frequency is high, so investors, traders are these guys, plus a little bit of a retail investors. Nowadays, it has to be very wealthy. In the earlier years, it's not that stringent. Okay, so interbank market are quote-driven market. Those are the OTC markets. Okay, that's the usual markets that you would know for these bonds. Trader size is really big. It's like a wholesale. Trading frequency is low, but once you trade, it's big, it's huge. So that's basically these two markets are different. And the banks are the main player, then all other people are there. No individuals. Okay, so that's where it's different. All right, and I explained it to you. You have a segmentation. The reason for the segmentation in the time that in the days that for our exercise is because buying a bond on one market and selling it on the other requires application for transfer or depository. So basically, there are two depository on these two markets. Then you need to transfer. This so the process that at that time you need to do it is pretty lengthy. It's like more than half of a week. You know, these are like you know, and in 2 weeks it's just the eternity if you want to do some arbitrage. And it's also think about it that the fact that there are a lot of liquidity problem. You know, bid-ask spread is high. So and last point is a very important. Trading sizes are drastically different from on these two markets. So it's almost impossible that you buy the same amount here and there. Okay, so these are just telling you there are two markets, the same bonds, but largely segmented. We cannot rule out there's definitely no arbitrage. That's why later on, you know, we will say it's perhaps the underbuys. Okay, so nowadays that is still there, but the process is much shorter. Okay, at that time, so this is really good for our identification in 2014. Because of these two differences in pledgeability and plus limits to arbitrage, that means that the same bond IT traded at different prices, we could have exchange premium. So from now on, we define exchange premium as a yield on IB minus yield on EX. And if you see exchange premium goes down, that means that the price, okay, traded bond price on exchange goes down relatively. Okay, so that just is, you know, it's the same sign as price. All right. So on the repo market, so the in the interbank market, the repo market is like a tri-party repo. You know, bilateral. If they want to borrow each other, they just figure a negotiated term, and then you just settle in the clearing the agency. For EX is centralized. It's kind of interesting is that EX will has a central counterparty CCP to all trades and no counterparty risk. So basically CCP here sitting in their central counterparty in between and basically assume all the obligations with each other and so that clear up all the transactions. What's also interesting is that they basically that you know, we usually think about this kind of repo have two dimensions in thinking about the price, right? One is interest rate, the other is a haircuts. The way that I think it's also in some European market is that the CCP set the haircut unilaterally and open to everybody because they want to standardize. You know, they can't say that okay, this same assets because and Dimitri come here so that I give him a better haircut, or because Jigo come here they will give me a worse haircut. That's just impossible because it's a change. It's basically anonymous. So they have to say that in the morning, every morning you have these assets. They assign some number as a haircut to you, and that's it. Okay. However, that during the day, right? During the day, that there are demand and supply on this. Given the haircut, there's a demand and supply for the borrowing and also lending, and as a result, that basically the market is gonna clear the interest rate. So the interest rate will become endogenous, fully reflecting market prices. Okay. All right. So here I put this slide here. It's basically this is the interbank repo model. Very, very normal stuff that you saw. While the stock exchange repo model, it has a stock exchange counterparty as in between, and both guys basically talk to the CCP. And the stock exchange counterparty will announce the haircut every day. And what we are exploiting is basically there's a one shot to this chart exchange. Okay.
Shinko, you have 10 minutes just to.
Total 10 minutes?
10 minutes left.
Oh, okay. All right. So we have this a policy shock, the night of December 2014 suspended the eligibility for the bonds. This is an unexpected policy shock suitable for our identification. You can see that later on. I will tell you the market. One thing that I want to mention is that before this shock, exchange blacklisted some individual bonds in 5 announcements since May to November 2014, but triggered a little market reactions. So the point that I want to make here is that there's a big background of the resolving the local government issues. Many different parts of the country that they all try to address the same issue, which is the local government debt problem. And as very common in China is that different parts always releasing some very small scale policies, but that the night of December 8/14 is really stringent. You can see it here is that basically that AA plus AA has a haircut probably 30 to 20%, and then slashes to 0 to 1, and the haircut is if it's a AA minus, then the haircut is 100% anyway, and the AAA is unaffected. So these are the treatment group. These are the okay. So this is what I'm telling you about the market reactions on that particular day. On that particular day, there's a exchange markets reacted to AA plus AA, and AAA does not change it. IB market also have that. One thing that and here is a blacklist announcement. In the past, just nobody paid attention to this. And what I showed you here is the raw transaction data, but not simultaneously traded. But as again, the exchange market, it's very important to understand that you have to match it. This is one key results that I showed you is that the IB market exchange experience before the event, after the event, okay, and for the half year. What we showed here is basically match the sample. Like we took one bonds, getting to the sample, and as long as it's traded in a very small time window, 2 days or 3 days. Okay, so this showed you that before the event, AA, AAA, very similar exchange premium, but the traded bonds really goes down. It's also AA minus also doesn't change that much. So that's a really good sign that is showing you that we can use this time event to identify what we want. Okay, so one framework very quickly is that we have this standard setting so that a PT equals the expectation of the pricing kernel times the fundamental plus a pledgeability premium. Okay, and we can link this lambda t as the Lagrange multiplier, and later on we can link to from our estimation to lambda t, but that's not the focus of our paper. We basically try to using this framework to tell you that how big is the premium. Okay, so the roadmap that I don't think I will have time to go through the second part. Hopefully the discussion will pick it up. I will just spend some time just telling you that what did we do on the first part using exchange premium to get the result. So
you have 5 minutes. So
yeah. So once it's lay out the setting, it's very easy to explain. So we have a bond I, rating J, haircut with cash flow Y tilde. So you see that from PIJT EX, PIJT IB, we have these two equations. This is a very basically empirical equation. So here we allow for IJ, that EX specific liquidity, EX specific time varying liquidity. Okay. The same M tilde, it's very important. Think about it that we have the same marginal investors active on both sides. The exchange premium, then when I take the difference, then I got basically these terms that I can absorb using various fixed effect. What's left is our key, is a lambda 1 minus H minus lambda 1 minus h on IB. The policy shock really just push the JTEX jumps to 1 from T to 0 for certain J. And I didn't show you the IB. What we need to make assumption is that there could be some time varying change, but largely a parallel shift across the entire J regression, across the entire J rating. So we managed to get some estimation from a major financial institution in China, and you can see that the assumption of a parallel shift is largely satisfied. Basically, it does not change that much, but the AAA changed a little bit. So we can correct for that. Okay, so once we have that, we can identify lambda based on this framework. Okay, so what we do is here is a AAA and with the two control, I put it here, that standard result goes down. And here is the plot that we have as a AA minus bound as a control versus the AAA bound as a control. You can see that really both gonna work. So this is really the unique part of our result. 2 slides on exactly that. How do you do the estimation? So we have an instrument, then the first 2-stage least squares. First stage projected the haircut on the policy shock. That's the exogenous. And then second stage using the stashed haircut to get that. So this is the first stage. First stage is the super strong. What I show here is a standard deviation. It's not a surprise. It's just the laser pointer target of the policy. This is the main result. So once we do the proper second stage estimation, you can see full sample is about 39 basis point, and we control a bunch of other things. It really does not matter that much. The policy design is really nice. What we also do is exclude AAA, exclude AA minus. That's just tell you that what if we use a different control? If you worry about a certain flight to quality, other issues that a different control have a different trend. And here is that what if we pick a different treatment, right? But you can see that almost all the numbers are the same. Here is the underestimation due to arbitrage that you could sort of say that suppose the impact is supposed to be really big, but if it's too big, then people start to arbitrage. So we worry that the potential it could be underestimated, and we have a method to deal with that. So let me just conclude. The method we were using to get the upper bias is basically that forget about the exchange premium, but only look at the exchange market matching the AAA with the AA minus, and that put all the possible stories that are maybe linked to the going against our identification will link to saying that maybe that the policymaker have some favorable information towards the AAA, therefore the effect is bigger than what we want. Okay, so that was what we do, and let me just conclude is that what we had is a estimate of causal effect on the change of pledgeability on asset prices. What we are utilizing is really a nice structure in China, in Chinese corporate bond market. There are 2 markets, and there's one market that a repo rule gets shocked based on some unexpected move by the exchange. The number here, 39 to 85, that's our estimation. And the price drop is 2.1% or 4.5%. We link this to the shadow cost of capital, we hope that this could provide open the door for the future research on the pledgeability as well as the Chinese bond market study. Thank you.
Well, thank you so much, Zhiguo. Now the discussant is Dora Shah from the BIS. Dora.
Thanks, organizer, for having me in the program and discussing Zhiguo's paper, which I really like. So the focus of the paper is the value of asset pledgeability. The concept is relatively simple. So as pledgeable assets can reduce the borrowing cost for financially constrained investors that carry a convenient yield, known as pledgeability premium. Roughly speaking, you can think of the premium as the product of the price of relaxing the funding constraint lambda, or the Lagrange multiplier, and the quantity of pledgeability, which is the 1 minus the haircuts. And the lambda will be the object of the interest of this paper. Why we're interested in it? Because it helps us to, say, evaluate effectiveness of collateral channel of some monetary policy tools, lending facilities such as TALF in the US or the title in the in Euro area. However, empirically estimating lambda is not straightforward because of the endogeneity problem that Zhiguo mentioned earlier. So in this paper, they overcome the identification challenge through 2 steps. First, they make use of a policy shock that introduce exogenous variation in haircuts. And more importantly, and which is make the paper unique, is that they leverage on the dual listing feature of certain Chinese bonds to sort of further purge possible endogeneity of the policy shock. So let's start with the shock. So the shock they use is the announcement on December 2014 that the repo eligibility of all enterprise bonds rated below AAA would be suspended in the exchange market. So as you can see, effectively the haircuts of AA plus and AA bonds raised to 100% after the announcement. Meanwhile, pledgeability of the double or AAA bonds, A minus bonds in the exchange market, and all the bonds in the interbank market, they remain the same. So this shock provide a perfect ground to examine how the haircuts would impact bond prices for 2 reasons. First, it's a surprise to markets, and actually the Chinese financial market media quoted as a sort of the black swan event. And also because this announcement only introduced changes in repo eligibility for a subset of bonds in the exchange market, so that we can use unaffected bonds both in the exchange market and also in the interbank market as a sort of control groups to parse out the time variation in bond prices that is unrelated to haircuts. So the next question is, okay, we have the shock, then what would be the right control group to use? Theoretically, ideal control group would be the bonds whose fundamentals are identical to affect the bond, so that the time variation in the price due to fundamentals can be fully controlled for. They do not exist in general, but thanks to the dual listing feature of Chinese bond market, you can have a very close match in this case. So just a very brief revisit of the institutional background. So in China, certain bonds can be listed in both market, the exchange market and the interbank market. And a large fraction of enterprise bonds, or the sort of the object of the of this paper, they are listed in both markets. The 2 markets differ in various aspects. First, they differ in the market, the investor base, but very likely they share the same marginal investors, the mutual funds, security firms, and insurance companies. The implication of the same set of marginal investors is that you have so for the same bond, you have the identical cash flow, and if you have the same set of marginal investors, that gives you the same SDF, the stochastic discount factor. So the pricing for the fundamentals will be identical for the 2 markets. But then these two markets differ in the repo practice and also differ in the liquidity conditions. And because of this, there's a wedge between the prices for the same bond traded in the 2 markets. And this wedge cannot be easily arbitraged away because the trade may not be profitable in reality with trading frictions, say the delay in transfer of depository Zhiguo mentioned. And the price wedge, or the exchange premium as the paper called it, because it does not depend on the fundamentals, we can really make a good clean inference about lambda from the exchange premium, because as you can see, it only depends on the haircut difference in the 2 markets and also some residual liquidity premium. But then but there's a catch in this market, is that the haircut in the interbank market is not cannot be observed, nor the liquidity premiums in the two markets. So the paper go ahead assume a particular structure for these unobserved variables. Essentially, what this assumption does is that it attributes the time variation in exchange premium not related to haircuts in the exchange market to a common time trend here. So when you take the difference, here. So when you because the time trend is the same for all the bonds, when you take the difference of the exchange premium between traded and control bonds, only the haircuts in exchange market that matters. Also, you plus some there are some bond or rating fixed effect. But then this fixed effect could be dropped out when you take the difference of the exchange premium over time. So this is basically the idea of the sort of a diff approach. Heuristically, actually, lambda you can simply calculate as the ratio between the difference in exchange premium between traded and control bonds before and after the event, and also the difference in the corresponding haircuts. So I did the calculation based on the bar chart that shows the average exchange premium before and after across different rating groups, and also the haircut, the time series of the haircut change from their paper. I did the calculation and I got a number 38.5, which is actually very close to the 39 basis point from their more rigorous two-stage least square. So I think it's a very good sanity check of their estimate. And the paper argues that this estimate is likely to serve as a lower bound of the true lambda. This is because when you have large price swing, it's very likely that the arbitrage trade is still profitable even after account for the trading cost. And then the cross-market arbitrage will narrow the exchange premium for traded bonds. So that will likely make you underestimate the lambda here. Then the paper proceed with another control group to obtain an upper bound of lambda. Zhiguo didn't have time to mention it, so here I will spend a little bit more time on that. So the this control group is the matched AAA bonds in the exchange market. So these bonds, they share similar credit spread and haircuts with the traded bonds before the event. So their fundamentals should be very close. Following the similar argument before, and the price difference will just depend on the lambda times haircut difference because their fundamentals are close enough. And heuristically, again, the lambda can be simply calculated as the difference of yields between traded and control bonds before and after the shock, and the corresponding difference in the haircut. Again, I just look at their plots and get some rough estimate, which comes to like 90 basis point, which again, it's in the ballpark of the 85 basis point they get from the two-stage least square. So I think it's a good sanity check for this part of the estimation as well. Why this estimate is likely to be have a upward bias? This is because when this policy shock probably reveals some negative information about the traded bond. So if that's the case, the yield of the traded bond will go up. And at the same time, this event is kind of, you can characterize this event as sort of the introduce market stress. And in this case, the matched bonds with higher credit ratings is likely to benefit from a flight to quality or flight to liquidity. And in this case, their yield will go down. So both of these channels will increase the yield that is unrelated to the change in the haircuts. That's why the lambda here is likely to be a upper bound of the true lambda.
Dora, so, 5 minutes.
5 minutes. Okay. Wow. So the key takeaway from the paper is very simple. It's the bound they estimate for the pledgeability premium per 100% change in haircuts. It's a great paper. And my comments is mainly about the possible changes also introduced by the shock and their implications for the estimation. The first one is the lambda. So this paper assumes that lambda is a constant. Well, it is a convenient assumption, but may not be the realistic one. So when you have a policy that increase haircuts of certain assets, the pool of eligible collateral assets shrinks. As a result, investor funding constraints are more likely to bind, and lambda would increase. So Ashcraft and his co-authors formalized the idea in their 2010 paper. And the policy shock we consider here and would increase lambda, and the impact may not negligible, because actually the shock impacted 75% of the enterprise bond traded in the two market, and their haircuts increased from 20 to 30% to 100%. That's huge. So there's a great reduction in the collateral pool, so very likely the lambda will increase after the shock. So the price change following the shock reflect not only the change in lambda, but also the not only the change in haircuts, but also the change in lambda. So let's just use the graph from Ashcraft paper to do the decomposition. So if we trace the arrow upwards for a scenario of increasing haircuts, we can see that the total price move can be decomposed in two parts. One is that the change in lambda times the haircut before, and the change in haircuts times the new lambda. So what will be the implication of the estimation? For the sake of time, I will skip the mathematics, but the basic idea is that it will introduce a time variation in exchange premium that depend on particular bonds. In that case, the triple A bonds actually might be a better control in this sense for their exchange premium analysis. And for match bonds analysis, the impact actually is not that big, because the haircut of the traded and the match bonds are very similar before the policy. But a related question is, how shall we interpret the 39 to 85 basis point, given that the lambda actually is the time varying, and what they estimate is likely to represent the lambda after the policy shock, which corresponding to extreme stressed market conditions. As the paper showed that after the policy shock, the liquidity measure of the Chinese bond market actually like a spike. So this lambda corresponding to an extreme stressful episode in the Chinese bond market. So how much can we generalize the estimate is a question mark. In that regard, probably it's useful to extend the analysis to other two policy shocks, especially the second one, which actually corresponding to a liquidity easing condition. So in that case, probably give us a better sense about the time dimension of the pledgeability premium. Yeah, for sake of time, I'll skip the details of the event and move to the my second comment. Another point about the shock is about the implicit government guarantee. So as Zhiguo mentioned, the background of the policy shock is the Chinese local government debt problem. After the great financial crisis, the central government released a 4 trillion RMB stimulus package, and most of them focus on the infrastructure investment. And the local government need to finance this project, because the central government actually only contributed to 1/4 of them. And because of this, there's a rapid expansion of the municipal construction bonds, or Chento bonds in Chinese. Because of the rapid expansion of this kind of bonds raise financial stability concerns, that's why the central government took a series of policies to control the local government debt problem. And this is the background of this shock. So if the shock actually, and for the announcement, while the removal of eligible collateral pool applied to all the enterprise bonds, actually the MCB actually was singled out, and they mentioned specifically about the concern. The exchange market mentioned them specifically about their financial stability concerns. So this shock could very likely triggering a repricing of the implicit government guarantee in this market. And what's the consequence in terms of the estimation strategy? You may wonder, because the exchange premium already sort of drop out of the fundamentals, so why I worry about the repricing of the implicit guarantee. There are two factors could be complicating here. The first one is the retail investors. So the exchange premium that not only depend on the haircuts difference and the liquidity conditions, it also depend on the retail investor demand, as a paper showed by Liu et al. In 2019. So the exchange, because if there's a removal of implicit government guarantee from the MCBs, it may lead to retail investor sale of these bonds, and we do not know what will be the rating category they want to sell. That will lead to change in exchange premium that is unrelated to haircuts, and also might be different across different bonds. And second one is that because the commercial banks in China actually is heavily involved in the Chinese local government debt problem. And if there's a removal of the implicit government guarantee, there will be a reassessment of counterparty risk in the interbank market. So in that case, it will also lead to change in exchange premium that is unrelated to haircuts. So
Dora, effectively your time is up. So if you can give us the punchline, and then
yeah,
I'm sure you will have time to come back.
Yeah, so the last comment, actually this is on my two main comments, and the last slides for my discussion is some residual comments. The first one is that the papers focus on lambda, which is a partial derivative of the haircuts, which of course it's very important. But then from the policy point of view, the total derivative might also be interesting in the sense that when you change the haircuts, it's lower the funding liquidity, it's lower market liquidity, it's a sort of increase the liquidity premium of these bonds. So, and also it will lead to higher default risk. So this is the channel work not through the haircuts, but through the fundamentals of the bonds. So the paper focused on the partial derivative, but I think the total derivative may also worth exploring if you want to know the whole package of the impact of the change of the haircuts. And the second residual comment is that one thing actually I find puzzling of the paper is that the event is characterized as a flight to liquidity. But if you look at the response of the AAA spread before and after the event, actually narrowed. It's narrow, and actually the narrow is quite substantial, 15 basis point in exchange and 24 in the interbank market. This is not kind of the classical price reaction you would expect from the flight to quality or flight to liquidity market conditions. So one way to reconcile that is that probably when the investors they face the liquidity constraint, they sell the more liquid assets, say the government, other than the AAAs, because they will suffer a lower transaction cost in that case. But if that's a story, that may sort of make the direction of the bias of the estimates in opposite direction. So yeah, the author maybe think how to reconcile that. Yeah, so basically that's all I have, and I hope the authors find them useful.
Thank you, Dora. Jiguo, any response, and then we'll open it up to questions. So if you do have questions, you can start raising your hand or sending a message in the chat box, and I'll try and pick them up.
I would like to collect the question first.
It might be easier if you respond, and then we'll.
Okay, all right. So thanks a lot for all your comments. Your potentially time varying lambda is a well accepted point that so you can see that what we are estimating is 6 months before and after. There's one important fact that I really would like to emphasize. It's also showed up in other comments that I think also it's a very unique to China. That usually you would worry without getting to the detail. When I started working on this project, I worry that when you policy shock hits, then there's a lot of fire sale, potentially very immediate fire sale for these bonds that get hit. As a result, that but that means that short term, the long term, all these effect is a little bit thorny on that. What is good about China, this policy, is that they are very careful in dealing with it, in the sense that they say that look, these kind of bonds loses the eligibility, but if you already gets in the pool, which means that already landed to you, then you are fine. It's just that whatever outside the pool, you're not eligible to get in, which basically said that there's no secondary market pressure to selling, but the secondary market outstanding bonds who is affected, their price will still have a shock. And that's a very clean way to emphasize to tease out the pledgeability part. So that part is that it's also saying that okay, so that it tells you that all the price effect gonna be slowly pay out, okay, and also that this is why we take the 6 month time window to really figure out the true whole impact of this policy. That's the one biggest one. The second one that I think it's very important to understand that we are looking at the same marginal investors. We understand that because the one market have two markets have a shared common investor, and the IB market has banks. They have their own stuff, and the exchange market have a retail stuff. And they might move the price, but these prices will move together in the sense that because whoever is sitting in between, they have to be happy. So therefore, so the condition will take these into account. And when I take these two prices again together, what's only left is on these liquidity effect that we were taking care of using these fixed effect with some structure. Okay. The third point I want to say is that I was not particularly sure about the AAA spread, because at that time, if I understand it, you're saying that the AAA spread shrinks, which means that relative to the treasury bonds, that there's a lot of demand for AAA. That's actually there's some liquidity event. This is a very consistent with what we see. Unless you are really like bad liquidity event, you fly to treasury. But if the shock is mediocre, then you fly to AAA. That's it just depends on how big the shock is.
Okay, thank you.
Yeah,
I see that Dimitri has a question.
Okay, yeah. So I would like to push, if possible, a bit the Zigo on the theory side, kind of the underlying theory for the effects. So the theoretical kind of model that is based on that in the paper is based on this first order condition of the leveraged investor, but there is kind of behind that there is kind of this equilibrium model by Garleando and Peterson, which somehow the logic is that there are some people who want to kind of take risk, and a cheaper way for them to take risk, kind of more effective way for them to take risk, is to invest in the assets that have a lower margin requirement, the lower haircuts. This presupposes that these other people who are investing in, so these assets become more expensive, but other people who are investing in these assets cannot kind of disinvest from them. There is some kind of either short selling constraint or some kind of constraint, position constraint for these other assets that so somehow I don't quite see how. I want to see a bit more kind of color on how this fits this market, because the low haircut assets are the AAA assets, or the whatever, the assets that are these assets are fairly liquid, and you also have these mutual funds who are in this market that have long positions. So why can't if these assets become more expensive, why can't these funds kind of hold less of these assets? So why there is not kind of some elasticity there? And perhaps also there's no way I'm bringing this up, because there's maybe an alternative story as well that is kind of building a bit on Dora's comments on transaction costs, that assets carry transaction costs. And if you hold this asset and it's costly for you to sell it, so maybe you want to borrow against it if you need cash, you want to borrow against that asset instead of selling it. And so, but then if the story is about transaction cost that is driving this premium, perhaps I don't know, one could explore more the implications of transaction cost. Does it matter more for higher transaction cost assets, etc.? So anyway, my questions are just a bit more on the theory side. If you can, it would be nice to elucidate a bit more the mechanism that is driving this premium.
Driving this, okay. So you're not talking about the shock, right? So there are two layers of this paper. We initially were in the earlier version of a paper. Now we took it out, is to explain to people that why there are these presence of these two markets, that why there are exchange premium due to the haircut. Is that the question?
Yeah, I want to know when the asset, you say one asset is going to become more expensive when the haircut declines. And I want to know why some investors are not migrating away from that asset? If it's more expensive, why don't they?
So
I'm pushing for more for the transaction cost interpretation. Perhaps I think maybe this may be a better story for the effect. This is why I want to.
So this is so I have to mention my friend. One of the co-author is an industry guy. So they active on both markets. They're active on both markets, and that shock hits, and they were one of the victim. And what I heard is that they like the market on the exchange markets are easy to borrow with a very small, like a kind of like a liquidity serve for the short term and a very frequent kind of a liquidity shortage. While on the exchange on the IB market, so there's an IB market which is very, very OTC and a huge, like the magnitude of the order that they get into is just about 100 times difference. So in that way that they serve different liquidity service on these two markets, and often the time they will do a little bit of the arbitrage, but as we explained that the arbitrage is a little bit risky. So that story that we were thinking to put it there, but in the end we thought it was a bit too complicated, and we were hoping that the little bit of the fixed effect there will capture that. Now things become a little bit tricky that when you have the shock to push on that, and then what we really hoping is that maybe this shock is a parallel shift for these bonds across different ratings. So that's the answer to you. So basically, the question is that you raise a very, very good point, is that if they're the same fundamental and they have different haircuts, why that they don't move one to the other? I'll give you the answer that they are serving different liquidity parts. What's also that built on to the first the answer is an interesting fact that in the IB market, that you talk to the big banks bilaterally, one by one, and sometimes they will discriminate against you. Right? If you get some problem, and they will talk to you, and the haircut could change, non-transparent. While at the exchange markets, it's all centralized version, and everybody treated the same. So for the security firms, if you're not that big relative to the big banks, they would like to hedge on both sides. Thank you for the question.
I have one final question here, and it's from Kathy Yuan. Kathy, maybe you just want to take over.
Hi. I just want to, sorry, I don't have good internet, so I'm just turning off my video. So the question here is actually minor. It's just saying maybe we can add, in addition to the price variable, can also use the turnover and trading volume to see where the market reactions are right after the policy shock.
Yeah. I believe that Chencho, we are doing some of these quantity plus the these liquidity. We reported the liquidity at the first part of the paper, just to tell you that the overall picture. In China, the biggest liquidity measure that are reasonable is actually the 0 days per, like, what is it called? Like how many days that there's no trade. So we use that and already produced some numbers on that. So the short answer is that over the 6 months, in terms of this like on the surface kind of a liquidity does not change that much, and So that hopefully that's basically still what's really matters is on this whether there's some parallel shift across different ratings. Because remember that in the empirical setting that we estimate, we could have EX specific liquidity factor. We could have IB specific liquidity factor, and it's suggested that if it's a parallel trend, that would be fine. That we are working on this issue. Thank you.
Okay, thank you so much. So now we have a coffee break, and we are reconvening at 3:05 London time and 4:05 Basel, quote unquote, time. Okay, thank you very much. See you soon. Okay, so I hope you're all back. The next paper is US banks and global liquidity. Again, it's a multi-authored paper, and the presenter is Wenjing Du. Wenjing?
Great. Thanks so much for inviting us to present this paper. This is joint work with Ricardo Correa and Gordon Liao, both at the Federal Reserve Board. So the usual Fed disclaimer applies. These are our own views. Let me start the presentation with providing you some important backgrounds for our study. Since the global financial crisis, we have experienced fundamental shifts to the monetary policy and regulatory environments. Most notably, in order to finance large amounts of quantitative easing programs, trillions of bank reserves are created by major central banks around the world. What are the bank reserves? So you can think about them as the checking account balance that the banks have in the respective central bank. Okay, so that's indeed a big change to the monetary policy because prior to the GFC, banks did not have much excess reserve beyond the usual deposit reserve requirements. On the regulatory policy side, among many other things, what the Basel III did was to introduce a leverage ratio constraint, which requires banks to maintain at least 3% capital against all assets, regardless of their risk characteristics. As a result, many types of traditional bank intermediation and market-making activities that rely heavily on using bank balance sheet become a lot more costly from this non-risk-weighted leverage ratio constraint perspective. To take a very concrete example, think about the short-term funding markets. Historically, banks act like the money dealer. They borrow from one player in order to lend to another player. Even though both borrowing and lending can be structured in a way so they're risk-free or close to being risk-free, such activities still show up on banks' balance sheet and expand the size of their balance sheet, make the leverage ratio constraint more binding. So the thesis of our paper is to say under this new regulatory and monetary environment in which banks have a lot more excess reserve and also in the meanwhile are much more constrained in terms of their total non-risk-weighted leverage, bank reserves play a key role in supporting the short-term liquidity provision of the large global banks, especially during episodes of dollar funding crunch. We're going to be discussing two types of bad days in terms of funding condition. The first is on quarter-end days. Quarter-end days are bad, in short, because even as of today, in many non-US jurisdictions, the Basel III leverage ratio is only calculated based on the quarter-end snapshot of bank balance sheet. The second type of bad days we're going to be looking at beyond these regulatory reporting days on days with large increases in the TGA balance. What is TGA? That stands for the Treasury General Account. This is the US Treasury's checking account balance at the Fed. A large increase in the TGA, as we will see, corresponds to a reduction in the total amount of cash available to the banking sector, other things being equal, and typically leads to tighter dollar funding condition. A direct corollary of this main thesis is that when reserves get scarce for the whole system, we're in trouble. In the sense the dollar funding markets gets impaired, as evident by the September 2019 money market turmoil. What are the broad takeaways for monetary policymakers? We used to think balance sheet policy from a central bank perspective is separate from the interest rate policy, because balance sheet policy is part of the unconventional policy. From this study, I think what we have learned is that the balance sheet policy in this new regulatory environment is so much intertwined with the interest rate policy because we need enough reserves to ensure a well-functioning of the short-term money markets. And by that corollary, if we hold the regulatory environment more or less stable, the large central banks' balance sheets are going to be the new normal well beyond the zero-B environment. Okay, so that's the overview. This is the empirical paper. We make use of a newly available form that's collected as a result of the Basel III liquidity coverage ratio in the US. In the US, the Basel III LCR is monitored on a daily basis. So we have a daily snapshot of individual banks' asset inflows and liability outflows by currency on a bank consolidated basis globally, as well as for some important material subsidiaries. And we manually map these LCR concept of inflows and outflows into the usual assets and liability items for the banks. And we generally do a good job when it comes to when compared with other types of bank regulatory filings. The sample period began in December 2015. That's the beginning of this daily reporting of the liquidity coverage ratio on this form. The main sample period ends right before the September 2019 repo market spike. But recently, we also extended the sample so that we can, if we have time, talk a little bit about the COVID-induced financial distress. It's really 6 banks in our sample. So due to confidentiality reason, everything I say and I show today are going to be about the aggregate activities of these 6 banks. So these are the 6 largest US banks. You can think about, sometimes they're referred to as the lender to the second to the last resort. Before diving into the activities of these 6 major central banks, I want to just take a minute to talk about the evolution of the Federal Reserve balance sheets in our main sample period in particular. So this plots the Fed balance sheet. Positive area denotes Federal Reserve's assets and negative area denotes Federal Reserve's liability. You can see the blue area is the Fed holdings of securities. So these are the treasuries and mortgage-backed securities. The unique feature of our sample period is that this is the first time since the global financial crisis, the Federal Reserve was actively reducing its asset portfolio holdings, right? So this is the process known as the balance sheet normalization. On the liability side, there are a few important items. Most notably, the red thing is the key object of study. That's the bank reserves or bank's checking account balance at the Fed. So the yellow thing is the rather steady growing currency in circulation, so bank notes. So as a result of a steady growing or relatively exogenous growing currency in circulation, in the meanwhile, shrinking Fed asset portfolio, the direct consequence is that the total amount of reserve in the whole system at the end of our main sample period, right before the September repo market spike, reached their multi-year low at the level around 1.4 trillion. Still much larger compared to the pre-crisis reserve level, which you can barely see from this chart. Another important object, which is going to be used for the second type of bad days, is this purple thing, and that's the TGA, or Treasury's checking account balance at the Fed. As you can see, other things being equal, meaning the blue is equal and the yellow is growing at exogenous rate, a large increase in purple is going to crowd out the red, corresponding to a reduction in the cash balance available to the banking sector. And again, typically correspond to a bad funding condition days. Okay, so to fix terminology, we're going to be zooming at 2 types of short-term liquidity provision in the repo markets and in the FX swap markets. So this is the typical cash flow diagram for the repo market transaction. Let's take the role of JP Morgan as the lender, as a dollar liquidity provider in the repo market. JP Morgan gives out cash to some USD borrower at time T, and in return asking for some collateral, typically US Treasury securities. At time T+1, the USD borrower repays the cash and JP Morgan returns the collateral. To quantify the extent of these type of activity, it's just a matter of reading the bank balance sheets. So to measure the amount of dollar lending in the repo market, we need to look up the line called reverse repo from bank's perspective, and that's banks lending in the repo market. The second type of activities, in my view, is pretty much analogous to the repo market lending, except in this case, the collateral is not US Treasury, but some foreign currency cash. So I'm giving an example of dollar lending, again, done by JP Morgan in the dollar-yen swap markets. So let's take a look at the cash flow diagram together. JP Morgan again gives the dollar to the USD borrower at time t. This time, the dollar doesn't go directly to the borrower, but goes through an intermediary, like an FX swap market dealer, which could be affiliated with JP Morgan, but not necessarily. In this case, the USD borrower also posts collateral, not US Treasury, but Japanese yen, and the dollar yen is transacted at the spot exchange rate. So now JP Morgan has Japanese yen. What does it do with the yen? It typically faces two options. It can either park that yen in the form of reserves at the Bank of Japan's deposit facility, which it has access through its Japanese subsidiary, or it can decide to lend out that yen in the Japanese yen repo market. So again, both options are risk-free. At time t+1, all the cash flows reverse. The USD borrower is going to repay the US dollar cash back to JP Morgan, intermediated through the FX swap market dealer. JP Morgan is going to get back its Japanese yen with certainty, either from BOJ or from the yen repo market, give the yen back to the USD borrower. And the exchange rate between dollar and yen at t+1 is known ex ante, is pre-negotiated, which is called the outright forward exchange rate. So this transaction, despite involving foreign currency, doesn't really involve any FX risk because both the spot and the forward exchange rates are known ex ante. And again, it's collateralized in the sense the Japanese yen is posted as collateral against the USD borrowing. Okay, but it does come with significant empirical challenge to come up a proxy for the magnitude of these type of activities, because all the cash flows, all the red and blue arrows that go through the FX swap markets are considered off balance sheets. So despite this amazing data, we really don't know much about banks' off-balance sheet activities. There is still hope, because if you look carefully at this diagram, it does leave a very important footnote on balance sheet, and that's the Japanese yen on-lending part. So that's our empirical proxy. Our proxy for the short-term FX swap market lending takes the sum of foreign currency excess reserve balances at the ECB, at the BOJ, plus additional foreign currency lending in the repo markets that is not backed by the foreign currency borrowing. So in the paper, we also discussed the robustness checks, where we borrow the BIS famous methodology to look at the overall US banks of foreign currency on-balance sheet assets, subtract off their foreign currency on-balance sheet activities to proxy for how much they are lending dollars in the FX swap markets. And we generally get a very similar results when compared to this version of a short-term FX swap market lending proxy. Okay, so that's the two markets. And let me show in terms of the economic activities that's going on in these two markets. So on average, our 6 US banks throughout the sample lends about $1.2 trillion in the repo market. And in the FX swap markets, we're able to pick up on average between 300 to 400 billions. So it's important to bear in mind, we're talking about liquidity provision of large US banks. If we were to look at similar data, if they are available for non-US banks, the relative importance between repo and FX swap market intermediation could be different. In the meanwhile, I also plot the amount of excess reserves that these banks have. And in the same time, just to give you a sense, how does the reserve compare to how much liquidity that they provide? So far we've been talking about liquidity provision or dollar lending. Next, it is important to go through the mechanics of how are these lending financed. And this speaks to what is the traditional model and what is the new model that we're introducing in this paper. So let's start with the baseline. So here it's a very stripped down version of bank balance sheets where we only plot the short-term scalable components, so super liquid stuff. On the asset side, we have short-term lending, such as repo and FX swap market lending, and we have reserves. Here, I purposely labeled reserves as drainable reserves to remind us not all the reserves on banks' balance sheet can be proactively deployed. So there's only a part of that that is not trapped by regulatory or self-imposed risk management practices. So that's the asset side. On the liability side, we have repos and we have deposits. So the traditional model of liquidity provision or financing additional lending is simply to borrow more. That's where the word matchbook comes from. So here in this case, you see that banks decide to lend more, say the opportunity is particularly attractive, intermediation spreads, as we'll discuss, are high, banks want to lend more, and that's additional lending is entirely financed by additional borrowing. Again, both borrowing and lending can be structured in a way so that they're risk-free, say involving repo and FX, but still there is an unhappy consequence of this panel B relative to panel A. That's in the sense bank's balance sheet is larger. Holding equity fixed in the short run, bank's leverage constraint is more binding. So this may not be feasible. Is there a workaround? And the answer is yes. And that speaks to panel C, which is a new intermediation method that we're introducing in this paper, which we label as reserve draining intermediation. Why is it called reserve draining? Because literally in this case, you can drain down your reserve balances to expand your short-term lending without increasing the size of your balance sheet or without even touching your external funding. Okay, so what's so good about reserve draining? It's good. It's very much neutral to the Basel III regulatory metrics. Why do I say so? If you look at the total size of balance sheets in panel C relative to panel A, it's roughly unchanged. Do you also worry about, for instance, the Basel III liquidity coverage ratio? And the short answer is you don't have to if you lend against US Treasury collateral, or if you put the foreign currency on lending in yen at the BOJ, or again against the JGB collateral, because all central bank reserves and treasuries are considered level 1 high quality liquid assets. Okay, so both your liquidity coverage ratio and your leverage ratio can be kept constant. In the meanwhile, you achieved your goal to lend more. If that's all, then we don't need to write this paper because there will be no more spikes in the short-term funding markets. Everybody would be happy. So as we will discuss a bit more, and Darryl is going to discuss further, there are additional constraints beyond the usual Basel III regulatory metrics that constrain the extent of reserve draining activity that can be done by large global banks. I want to highlight one. So Darryl is going to be talking about
just to make sure, forward guidance. You have 10 minutes.
Okay, great. That's plenty. So Darryl is going to be talking about intraday constraint and the difference in the intraday liquidity profile between reserve and repo. So I also want to highlight there is also a distributional concern in terms of distribution of liquidity across entities and jurisdictions. So if we think about the reserves or drainable reserve, it's like the cash you have in your wallet. For large banks, it's actually not so easy to spend the money because where you have your wallet is different from where you spend it. And this diagram summarizes the dichotomy. So under a large bank holding company, we typically have the deposit institutions, which can hold reserves because they have reserve accounts at the Fed. But we have the broker dealers that are doing most of the repo and the FX swap market lending. In order for the reserve draining operation to work, you have to have enough willingness for the deposit institutions to run down their reserves to then lend that internal liquidity to the affiliate broker dealers so that that can be used to finance their external lending. Okay, so any additional friction that you can imagine that limits the extent of the intra-firm liquidity sharing, either between DIs and BDs or across jurisdictions like the ECB versus the Fed, would limit the extent of the liquidity provisions financed through reserves. Okay, so why are banks doing all this trouble to intermediate? And the short answer is because they can earn handsome profits in a pretty risk-free ways. And how big are these profits? So these are quantified through a variety of intermediation spreads. So I will not have time to go through each of them individually, but more generally speaking, if you look at these intermediation spreads, on average, they're about 10 basis points in the normal day. They are quite spiky. And the spiky days are days with tight funding conditions. And you can see one set of large spikes coincide with the quarter end days, as summarized in this event study. Repo spreads spiked about 20 to 30 basis points. FX intermediation spreads spiked up to 150 basis points for the euro and even close to 400 basis points for the yen on an overnight basis. So what do US banks do when facing these large increases in intermediation spreads? Do they act very proactively? And if so, how is that additional liquidity provision financed? let's take a look at the meat of this paper, which is this 4-panel in terms of summarizing US G-SIB's intermediation activities around quarter ends. So let's first take a look at the lending, which are these 2 panels on the right. Interestingly, US banks did not increase nor contract their repo market gross lending around quarter ends. Their repo lending is roughly steady throughout quarter end. They do increase significantly their FX swap market lending by about 20 billion. Is this coming from matchbook? Absolutely not, because if you look at the lower left panel, their repo borrowing is actually down by 30 billion. Everything is coming out of reserve draining. Reserve is down by 50 billion, which is enough to make up the 30 billion loss in repo financing, and so that the banks overall can keep its repo lending steady and meanwhile afford a 20 billion expansion in the FX swap market lending. So that's on the overall level. And as promised, I also show you evidence in terms of the intra-firm liquidity sharing between the broker-dealer arm and the non-broker-dealer affiliates. And that's what this slide is for. As you can see, the broker-dealers, consistent with the whole bank's activities, significantly cut back their repo market borrowing from the external unaffiliated third party by about 30 billion. We know they didn't change their repo lending. Their repo lending position was flat throughout quarter end. How is that possible? It is well possible if it does actually borrow internally from the affiliated non-broker dealers and typically deposit institutions by exactly 30 billion, which makes up the loss in the external financing. Okay. So that's the first type of bad days. The second type of bad day is days with large increases in the US Treasury account balance, Treasury General account balance. So this plots the TGA, the time series, and the min sample period. The TGA can fluctuate up and down by a couple hundred billion. In this post-COVID metric, that was considered small, but now the TGA fluctuation are even much bigger when the level was like above 1 trillion. But 200 billion can mean a lot, right? If you think about the overall result we just saw from quarter ends, US banks were on net increasing 20 billion of their net liquidity provision. So 200 billion for the short-term money markets can be a large shocks for banks to absorb. Why do I say a large increase in this red thing is typically a bad day? That's evident from this scatter. It's a very simple scatter where we plot the daily change in the TGA balance in billions of dollars on the horizontal axis, and we plot a very clean repo spread on the vertical axis. This is the secure overnight financing rate, the floating rate benchmark, primarily consisting of repo transactions that is going to replace LIBOR. So very much a clean index. So even with this clean index, you see that it's very much subject to the so-called technical factor, right? When TGA balances are large in terms of daily change, there is an increase or tighter repo market conditions, right? And if you look at the small TGA change, showing this light blue area with fluctuation below 20 billion, it's largely a cloud. But when the change in the TGA balance is pretty large, say over 20 billion in absolute values, the slope gets pretty much significant. And it's not just the repo spreads. We can also look at other types of repo spreads or the FX swap market intermediation spreads. And the conclusion is pretty much similar. They all respond positively to large changes in the TGA balance. So large TGA days are indeed bad days in terms of the overall funding condition. The question is, what do US banks do again in response to this other type of bad days? And if you believe the quarter end results, the next slide I'm going to show you pretty much tells the same stories. So if we look at this next slide, again, starting from banks lending side, their reverse repo position is largely unchanged in response to large TGA change. Their FX swap market lending position does increase significantly. Is everything financed externally? The answer is absolutely not, because their repo financing actually declines. Just as the quarter end evidence we saw, everything is coming out of reserve. So banks drained enough reserves to finance a steady amount of repo lending, despite that there is a loss in repo borrowing. And in the meanwhile, banks also increases its FX swap market lending. Okay, so reserves are getting reserve draining, particularly play a very important role in getting us through these large TGA changes. So the final 3 minutes, I'll comment a bit on what happened in September 2019. So all the regression you saw so far were conducted right before this money market turmoil. So what happened exactly on September is through the lens of our two shocks. That was September 16th, not a quarter end, but it's indeed a large TGA day. It's a corporate tax payment day. It's also settlement day for two large treasury coupon bonds. So 83 billion, if you go back to our scatter, it's not the largest, but it's fairly large. And the repo spreads did react on the first day. Repo spreads was elevated off the regression line, but on the 17th, as we can see from this intraday charts, the morning of 17th, things really went well. The repo market reached to close to 10%. The Fed immediately relaunched the repo facility, which allowed dealers to borrow directly from the Fed, as opposed to from the dysfunctional private repo markets. So what this chart also shows, in addition to the repo rate, we also have the implied dollar funding rate from the overnight FX swap markets, which moved pretty much in tandem with the repo rate. So that you may not know, it's not covered in the press, but it does show the two markets are very much synergistic with each other. So what we can do from our empirical analysis is we can predict what would be the usual response to an 83 billion TGA change for our US G-SIBs and compare that with their actual response. We decide to use September 16th as this empirical analysis window as opposed to the 17th, even though the 17th is more exciting. The reason to choose 16th is because the Fed hadn't intervened yet. Interestingly, and also to our surprise, I don't think the US banks, based on our analysis, are the ones to blame, at least based on this narrow empirical exercise, because their reserve draining, their repo market lending, repo market borrowing, net repo market lending, FX swap market lending, deposit, and treasury holdings, their behavior, at least on the 16th, are largely in line with what we would expect for 83 billion TGA increase. But if there's something else going on that may have triggered the earlier onset of the pressure in the afternoon of the 16th, we do find that the foreign banks, which do hold a huge chunk of the reserve and play a very important role in the global intermediation of the US dollar liquidity, significantly underdrained their reserves in the order of magnitude about 20 billion. So there is some evidence that it's possible the foreign banks hit their constraint even more on that day, and that could be acting as a trigger for the ensuing market distress. So let me just wrap up. So what we have learned from this paper and this project overall is having enough reserve is very important to the well-functioning of the short-term interest rate markets. We also learned this internal transfer, the synergy between the traditional bank, like the commercial banks, and the shadow banks, like the affiliated broker-dealers, are very important. And hopefully the lessons we learned from the previous period of balance sheet normalization could inform the ongoing or the subsequent discussion that we're going to have to face when the Fed is going to start thinking about tapering. Okay, and I'll just stop here. Thank you so much for your interest.
Thank you very much, Wenxin. I didn't even have to show you the 5-minute board. You're really sort of very, very disciplined. The discussant, 15 minutes, is Jeremy Stein. Jeremy, good to see you.
Can you hear me and see my screen okay?
Yes.
Okay, well, thanks very much for including me. I'm really happy to have been matched with this paper. It's a terrific paper, and I really enjoyed reading it. And let me start by apologizing. I'm going to be a disappointing discussant because I don't really have any bones to pick with the empirics, which I thought were very clear and clean and compelling. So what I'll do instead is I'll just try to briefly summarize. There's kind of a lot here to unpack, especially if you're not super familiar with kind of plumbing stuff, and say a little bit about why this matters, and in particular, what some of the implications are for regulatory design. There's really a lot. I mean, Wenxin went through this, but there's just a lot going on here in terms of different rules that sometimes kind of pull in different directions. And I want to try and talk about sort of normatively what might you want to do based on some of the issues that are flagged in this paper. So I'll try to draw that out a little bit. Okay, but first, just to summarize a little bit, how do banks, let's just imagine a very particular situation. bank's facing a spike in demand to borrow, sort of for overnight borrowing. Let's say all of a sudden hedge funds need to borrow to finance their treasury holdings. How does this get done? Sort of two basic ways. This is just the picture that Wenchen showed. The sort of pre-financial crisis standard way is something called matched book, where basically if the bank needs to lend 100 units, they go out and borrow 100 units in the repo market, and then they turn around and lend. They borrow from, say, a money fund in the so-called tri-party repo market, and then they turn around and lend it to the hedge fund on a bilateral basis. Okay, so that was sort of how things went. It had the aspect that doing so increased the size of your balance sheet because you were both borrowing and lending. Okay, that has become constrained, and I'm going to say much more about this, that has become constrained by the fact that for many of these guys, the so-called leverage ratio, which is risk insensitive, just looks at the size of your entire balance sheet, is binding or near binding. So the alternative, and this is something you can do in a post-crisis world to some extent when reserves are more ample, is rather than expand the size of your balance sheet, you can just draw down on your stock of reserves and use that to finance an incremental loan, right? So your balance sheet changes composition on the asset side. You have fewer reserves and more lending, but you haven't bumped up more against the leverage ratio. And the basic sort of essential finding of this paper is that in the new world where leverage ratio constraints are surprisingly binding, this reserve draining way of accommodating essentially spikes in demand is what you see in the data. Okay, so when there is a spike, banks accommodated basically by draw, or the big banks, I should say. The banking system as a whole is going to hold all the reserves, but the G-SIBs that are the active lenders are basically drawing down on their reserves. Okay, there's a very nice empirical design. In fact, there are two very nice empirical designs, one having to do with quarter ends and one having to do with the balances that the Treasury holds at the Fed. Let me just say a little bit about the former, because Wenchen went over it kind of quickly. There's a little bit of nuance here. So basically, what are they doing? They're looking at quarter ends, and they're looking both at price and quantity, at the intermediation spreads, and at how the US G-SIBs respond. Now, the sort of subtlety in the identification here is the difference between the regulatory treatment that foreign banks face and that US banks face. So foreign banks, by and large, the leverage ratio is imposed on them based on a sort of quarter end snapshot. So we look at their balance sheet on the day of quarter end and say, how big is it? That's the leverage ratio you're held to. So the foreign banks have an obvious, and this has been shown in previous work, have an obvious disincentive to have a large balance sheet, particularly on quarter end days. Okay, so they're going to be aggressively trying to shrink their balance sheet. The nuance is that the US banks, by contrast, for them, the leverage ratio is imposed not based on a single day, but on a sort of average over the quarter. So they do not face the same sharp disincentive to hold, to have a big balance sheet at the end of the quarter. So there's sort of a comparative advantage thing. So what happens at the end of the quarter, basically, the foreign banks are doing less intermediation. That is causing repo spreads, the spread, let's say, between the repo rate and either the sort of, repo rate that you would lend to a hedge fund and that they can borrow in the tri-party market, or alternatively, the repo rate and interest on reserves, which is the relevant spread if you're taking the money out of reserves and putting it into repo. That thing is going to spike, and the US banks should be basically taking the other side of the trade relative to the foreign banks. Okay, so that's the essential idea. We're said a little bit differently from the perspective, from the sort of partial equilibrium perspective of a US bank. It's like a spike in borrowing demand, right? Because the other guys are kind of getting out of the business. Okay, and what you find is exactly this sort of pattern of it's all coming out of reserves. So the US G-SIBs basically on these days reduce their reserve balances by about 50 billion. Where does that 50 billion go? Roughly, and they have this very clever way of sort of indirectly measuring lending in FX. 20 billion goes to lending and FX, and the other 30 billion is effectively an increase in their net repo lending coming from them doing essentially less repo borrowing, 30 billion. Okay. Now, again, there's a question of where do their reserves go? If reserves go down by 50 and total reserves in the system haven't changed, they must show up somewhere. It looks like they're sort of showing up in the smaller banks. And I guess the way to think about this is the smaller banks are sort of passive. And so I don't know, the hedge fund is borrowing and depositing, and eventually it winds up someplace else. So that's the basic finding. And again, it's very hard. And this is pretty cool. I mean, they have this daily data. It's one thing to have daily data on spreads. They have daily data on the balance sheets, and that's what allows them to do this. And it's really quite fascinating. All right, so that's what's going on. So why should you care? So the thing that the results really speak to most directly is the idea that the leverage ratio is binding. And because it's binding, we don't like to, we don't see the banks doing the sort of balance sheet expanding intermediation anymore. We see them doing this repo draining. But of course we have, reserve draining. Of course we have like trillions of dollars of reserves. So why isn't that perfectly fine? And so, okay, we can't do it the one way, but we can do it the other way. The Fed has put so many reserves into the system, that should kind of work. We will see, Daryl. I mean, it's a great program, Claudia, that you guys have put together. So Daryl's paper is in some sense Daryl and co-authors are in some sense going to get exactly into this, documenting very convincingly that reserves are not as ample as you might think, which is it's amazing because think before the financial crisis, we had reserves in the sort of tens of billions. On the eve of September 2019, they were 1.4 trillion. And they were manifestly scarce, just as evidenced by the spreads that you saw. So this is, again, a little tricky to understand. It seems, and I spent a lot of time, because you could see this coming in the months leading up to September 2019. You could see that reserves were starting to get scarce. Sort of market spreads were starting to tell you this. It's a little tricky to understand exactly why. The first thing you would reach for would be the so-called liquidity coverage ratio, which is basically saying that banks have to hold a lot of liquid stuff. But as Wenshin said, the liquidity coverage ratio technically is blind to the difference between, it says you need to hold a certain amount of either treasuries or treasury repo or reserves. So that by itself shouldn't create a very strong preference for reserves. The other thing that was puzzling is if you looked at the reserve holdings of the G-SIBs, they were very heterogeneous. In other words, I think it was JP Morgan had much more, Citi had much less. Their HQLA portfolios were quite all over the map in terms of the mix between treasury and repo. So I have to say, I don't exactly understand why they were scarce. There are a few stories out there. One is that the liquidity coverage ratio as a rule doesn't discriminate, but that supervisors do liquidity stress testing, and that sort of seems to favor reserves. There's the resolution stress testing and resolution positioning, and again, this is all quite anecdotal. And Daryl in his paper talks about enhanced sort of supervisory focus on liquidity risk. I mean, again, there's something going on here. At least personally, I don't feel like I understand it, and I don't understand the cross section well of why some banks were sort of have sort of a higher threshold for holding it. But there's something going on there. So here's the mea culpa portion of my presentation. I was at the Fed when I think most of this stuff got put in, and it's really kind of a Rube Goldberg device of a bunch of different policies. And I will tell you kind of how this happened. I mean, we sort of worked on these in what in retrospect is an overly siloed way. We would think about liquidity regulation and we'd think about, well, what's the right way to do that? And then there's a different part of the organization that's doing QE and a different part that's doing the leverage ratio. And you can see when you look at all these together, they just sort of create conflict. So there's the leverage ratio, right? And so we've seen the problems that the leverage ratio creates. it basically, I mean, it creates a lot of problems, not just this. It basically leans, if it binds, and if it's calibrated aggressively, it leans against safe activities. It leans against not only repo, it prevents, for example, in March 2020, the big dealer banks from just taking on inventories as market makers, inventories of treasury securities. So it leans against market making, for example, as an activity. Okay. There's liquidity regulation. So you might say, well, that if there's the leverage ratio, we should have more of the reserve draining stuff. As I've said, the liquidity regulations kind of as a whole, not just the LCR, but the general kind of liquidity stuff makes it harder for that to happen. So even as banks try to substitute towards that, reserves start looking kind of scarce. Then we get to the thing that Wenxin mentioned. Well, isn't the right answer just for the Fed to maintain a very large balance sheet so that reserves are not scarce? And so I have a lot of sympathy for that. I think that's a good answer for a number of reasons. I mean, at sort of lurking in the background of this is sort of the idea of the Friedman rule, that why would you want to make money scarce? Why would you want to be creating various intraday problems? So there, I think there's a host of reasons why you might like to have ample reserves. But, and here's the contradiction again, you start putting a lot of reserves in the system, the banks have to hold the reserves, right? They're the only ones who can earn interest on reserves. And well, that blows up their balance sheet, and then you're back to the leverage ratio binding again. So you can see it's just sort of a mess. And there's lots of individually good ideas, but it's hard to make it sort of cohere. So what are some possible ways? So this is sort of, where do you go with all of this? What would be, and I'm just sort of assuming you can get anything done you would like to here. What are the possible ways out of the box? I think my first step, and I like, again, the ample reserves, but I think the first thing you have to do, and this is hard, this is politically hard, because I think the leverage ratio is, at the end of the day, sort of a political totem. I think you would like to ideally defang it one way or the other. In other words, it's a binding constraint. It's very uneconomic to have a sort of risk insensitive thing be the binding constraint. You could either accomplish that in principle by dialing it back, make it not 5%, but 3%, let's say. You could, as was temporarily done in the wake of last year, you could exclude reserves from the denominator. That would make it easier for the Fed to obviously run a large balance sheet without running afoul. Alternatively, it's just about what's binding, right? So another way to make it less binding, that's a little more hawkish, is to dial up, is to make more stringent the risk-based, so you get some clearance that way. And of course, in the risk-based regime, it's not a stupid idea to have some non-zero risk weight on long duration treasuries. It shouldn't necessarily be the same as the risk weight on a leveraged loan, but you could have that. So if it was up to me, I would find a way to weaken the bindingness of the leverage ratio while at the same time making sure that total dollars of capital in the system didn't fall, perhaps by simultaneously cranking up the risk-based. Second thing that's a good idea, I think, and we saw this sort of used on an ad hoc basis in 2019, is for the Fed to have essentially a standing repo facility. Now, one feature, if we're not able to fully defang the leverage ratio, one kind of design feature is who has access to this repo facility. I would argue that, especially when the leverage ratio is potentially binding, I would like the Fed to be basically willing to lend to pretty much anybody who can post treasury collateral. Why? It's for the sort of the same reason that we've seen. If you just have this facility open to banks or to bank affiliated broker dealers, the Fed can lend to them. But if they need to on-lend to somebody else, again, that is going to potentially blow up their balance sheet, and they may be impeded from doing that by a binding leverage ratio. Okay, so in other words, the money sort of will get stuck and not be able to flow through the system. So I think it's a benefit to have this thing have broad access, and I think the Fed's exposure, if they're adequately collateralized by treasuries, is hopefully not too problematic. Another thought, and again, this gets to, I don't really understand where the demand for reserves comes from. but it's possible that if you have a standing repo facility, for some purposes, you'd be more comfortable holding your liquidity in the form of treasuries rather than reserves, because you know that if you need to in a pinch, you can always intraday basically post the treasuries to the Fed and monetize them. So in some sense, the treasuries will become a little bit more money-like in the face of a repo facility, and you'll tilt the relative demand for treasuries and reserves. The last thing that you hear a lot about is central clearing of various sorts. Let me focus just as a last thing on a particular version. This is clearing of treasury repo, which has various benefits. One benefit in this particular context is that if you do that, and you have banks doing essentially what the old kind of matched book stuff, if they novate this the matched book basically to a central clearing party, that will net down some of the balance sheet bloat that is giving them trouble with the leverage ratio. Okay, so that's another way. Again, you might say the best way to do this is just to get the leverage ratio out of the picture. If you can't do that, you might think that there's an additional benefit to having this kind of clearing. And interestingly, this is basically sort of happening with what's called sponsored repo, which is a private market response to the bindingness of the leverage ratio. So what happens here is banks basically sponsor, they kind of endorse their clients, and that enables the clients to basically meet the obligations, or the clients don't have to meet, but the clients can now clear with the fixed income clearing corporation without having to do some of the stuff that might otherwise dissuade them. And that allows the banks to essentially reduce some of the balance sheet bloat associated with matchbook type of activity. And it's interesting, precisely, as evidence of the bindingness of the leverage ratio, this market has grown fairly considerably. It now sort of has typical balances in the 200 to 300 billion range. And again, as evidence of the tightness, it peaked at over 500 billion in March 2020. So let me stop there. Again, this is a terrific paper. Interesting in its own right, disconcerting in what it tells us about kind of the mix of regulation and how, to some extent, we're tripping over ourselves, and helpful in that it, I think, points the way to potentially doing some things a little bit more thoughtfully. Thanks very much.
Thank you, Jeremy. Wenxing, would you like to comment? I guess your paper, he didn't find any flaws in the paper, but maybe you would like to make some general comments.
Great. Yes, thanks so much. Yeah, I guess I primarily want to say thanks so much, Jeremy, for the overly generous comments. I'm completely in agreement with you. I mean, the sort of the proposal, which wasn't so much of a proposal in the paper, we brought up about ensuring a large balance sheet. That's more about holding the regulatory development constant. But of course, you can sort of tweak the regulations so that the whole market doesn't have to lean so much on the central banks running everything. So that's certainly true.
Thank you, Wenxing. Comments? Anyone? Questions? I can only see. Well, let me first of all make a general remark. I guess many of us, to some extent, are looking back with nostalgia to the pre-GFC kind of environment where everything was so simple. Everything was so simple, and there was hardly this kind of segmentation in markets. And well, one question actually that I would like to ask, taking the sort of chairman's privilege, is, and this applies to both of you, and I guess it will apply also then afterwards to Daryl and the others. Do you think now we have a regulation and supervision playing a key role in all of these markets in a way that it didn't before? At the same time, is extremely important to have those regulations being in place, and we have seen how well they have worked during the COVID crisis. And there may be also the argument, which I think has a lot to go for it, which is sometimes you would like to have less liquidity in normal times to make sure that you don't have too much liquidity and the illusion of liquidity that basically generates some of the conditions for a very sharp evaporation of liquidity in bad times. But in general, I mean, maybe Jeremy, you were alluding to this. You were talking about the specificities of the US market, then we'll hear a lot about the specificities of the Euro area market. Do you think that something has gone wrong in all this? We've got the balance right, wrong? Because obviously we wouldn't like to weaken regulation and supervision, particularly over the core of the system, CCPs and banks.
Yeah, I mean, I think the important thing is not to just frame it as too tough or too soft. In other words, you can absolutely be, in the context of this kind of thing, you can absolutely be, for example, a hawk on capital, but say there are smart and less smart ways to do it. And a less smart way to do it is, and again, I think this has become to some extent a political totem for some kind of hawkiness, is to say, I'm a strong believer in the leverage ratio. Again, my preference would be, my sort of global preference would be to tighten the risk-based. And that, is you just want clearance. You do not want the leverage ratio to be the binding constraint, right? I mean, now you think we've come full circle, right? Back in like the old days, in the bad old days, there was risk-insensitive capital. What did that do? It did obvious things. People took more risk, and because everything was treated the same. Then we got to risk-based, and then risk-based had its problems. So now we're sort of reverting back. There's going to be problems with any rule. Any rule is always going to get arbitrage to some extent. And the fix for that is not necessarily always another rule. That's why you need supervision. Supervision can fill in the gaps where sort of the rules kind of, the rules can only go so far. Supervision can fill in the non-contractable things. But trying to fix this with the leverage ratio, I think, was really a quite fundamental mistake.
But in fact, I mean, as we'll get back to this, but some of the possible reasons, some of the binding constraints may well have to do with supervision as opposed to the regulation. And you mentioned a few in terms of the liquidity management, stress tests and the like.
And another perspective I want to bring up is relative to the pre-GFC simple world, right? Banks are, much tighter regulated. So we have to accept the fact that, yes, they're safer and more resilient, but they also probably have a smaller footprint in the markets, right? So in a sense, especially you can look at the COVID 2020 experience, right? If they were not so desperate to fix their own liquidity mismatch, they are relatively, they're not as useful, they're not as active in the market just as the intermediaries that are collecting some intermediation spreads, right? So when things get really bad, I mean, we shouldn't bet on them being there to be the lender of second to last in line. So the Fed and central banks need to probably be more proactive.
We're getting to
just to finish the thought, if I might.
Jeremy,
that if you got the leverage ratio out of the picture, then you could be very much in the kind of world that Wenxin describes, which is if we're going to have tighter liquidity regulation, okay, that's fine, but then the central bank has to accommodate that with its balance sheet. In other words, if the demand for reserves is going to basically be made to go up, we can accommodate that with a big balance sheet. Those two are internally consistent. But I think you can't, all three are sort of don't, those two plus a desire to have a leverage ratio is where you, I think, start getting into things that can't, trilemmas, if you will.
Right. I can see this discussion could go on forever, actually. I have one more technical question from Kathy Yuan. Kathy?
It's actually pretty much a follow-up on Jeremy's last comment on the CCP. My understanding of GCF repos may be incorrect in the sense whether the netting benefit can completely take care of the matchbook problem. If it is, maybe you can also look at the volume of quarter-end GCF repos versus trade-party repo that are now cleared through the CCPs. Obviously, the mesh that will benefit, lessen the constraint using the GCF clearing facilities through the FICC.
I'm not sure I have a good answer to your question. I'm not sure. I don't understand exactly well enough the mechanics of how the computation works when the stuff is, when the repo is sponsored and how much that reduces. So I have sort of a vague impression that that reduces kind of the balance sheet demand, but I'm not sure enough about the calculation to be able to answer your question.
I am actually consciously technical break, which we're going to skip. I have 3 questions. Well, actually, it looks as if there are 2 now. One is from Hyun, and the other is from Iñaki. Hyun?
I think this is a great paper. I think we have a great paper coming up as well from Daryl, and it's and as Jeremy said, I think these are very closely related. I think Jeremy's discussion really lays out nicely the policy challenges, and you know, I would actually go one step further, Jeremy, in not only looking at the leverage ratio and other aspects of banking regulation, but also the MBFIs. If we think about you know, margins for CCPs, I mean, they're still very much geared towards credit risk. You know, that's their kind of rationale. And certainly we saw the Treasury hedge funds. They were doing this mix and match leverage, you know, through sponsored repos, but also then hedged with the futures. And I was very struck by this paper that Dan Perullo and Andrew Metrick had at the recent Brookings panel, you know, which is exactly in the same spirit as your comments, Jeremy, but I think taking it one step further, which is, can we think about something coherent across the board, including the MBFIs? And I think that's probably, I mean, I'm not actually solving the problem, it's making it harder. But I just want to underline the fact that your argument can be taken even further. And I think this is also true of the Fed's standing repo facility. I mean, if you have, I mean, it's really about who has access to that, who can actually use that to do the mix and match leverage across different venues. If you can shop around to get the maximum leverage, but each venue is using a different principle, you know, that can also be a potential issue. And so it's probably not a surprise that it's the leverage ratio that's binding, because that's the one that's had the longest track record and probably has the more rigorous thinking behind it.
Okay, thanks. I think it would be better to move on. Iñaki, could you take this question bilaterally?
Sure, no problem.
Okay, all right. So then let's move to the next paper and the final one in this session. In fact, we're just continuing the same discussion because it's exactly on the same topic, although it's zeroing in on a particular episode that in fact was already raised before. The paper is entitled "Reserves Were Not So Ample After All." Again, multiple authors, and the presenter is Daryl Duffy. Let me just say before we start that I will have to leave at 5:30 because a meeting has been called that was not supposed to be there, but I have to be there. And so Andreas will be taking over at that point. But let's start, 25 minutes. I'm so sorry about that. Daryl?
Okay, and now am I unmuted?
Yeah.
Okay.
Yes.
Perfect. Okay, as Jeremy and you, Claudia, have suggested, and was clear from Wenshin's presentation, these 2 papers are very complementary. We're going to address essentially the same concern that reserves were not sufficiently ample to lubricate the funding markets, but we're coming at it from a different perspective. And we're also addressing whether reserves were ample to even serve the basic purpose of running the payment system. because we're finding evidence that during the day, banks were holding back on offering funding to repo markets exactly on those days in which their intraday payment timing was under stress because they didn't have enough reserves to pay out or lend out in the repo market in light of what they were getting paid in by others. That's the basic theme of our discussion. And as Jeremy hinted or guessed, a lot of this has to do with post-financial crisis liquidity regulation, not LCR, but intraday liquidity regulation. There was plenty of reserves in the system if you relax the intraday liquidity regulation and let banks overdraft or use their reserves more amply, but they didn't. They were afraid to do that. It's kind of the trilemma that Jeremy described, where the regulators have to relax some of this in order to get the system moving properly. This is joint. Oh, let me not forget to say this is joint work with Adam Copeland at the Federal Reserve Bank of New York and Elin David Yang, who is in our doctoral program at Stanford University. And needless to say, the views expressed do not necessarily reflect those of the Federal Reserve Bank of New York or the Federal Reserve System. Okay, so here's the balance sheet normalization that Wenshin referred to, but we've broken the total amount of reserves in the system into 3 colored segments. The blue segment at the bottom are the 10 largest banks active in repo markets, whether US or foreign. The red banks in the middle, those are the next 90 largest banks by reserves during our sample period. And then the green banks are everybody else, but we're not paying any attention to them. All the action is in this paper is with the 100 largest banks, the blues and the reds. And you'll notice that the balance sheet normalization brought the large repo active banks, the blues, down to relatively low levels and kept them at relatively low levels for an extended period of time, during which we see these spikes in repo spreads relative to the deposit rate that banks were given at the Fed. There's 2 time series here. One is SOFR minus IOR, and the other is the GCF, which is a more interdealer rate minus IOER. They're telling basically the same story. The GCF spikes are a bit higher. Why spread to IOR, the interest offered by the Fed on reserves? Well, that's because as a bank, you can either invest risklessly overnight at the central bank, or you can invest risklessly in the overnight treasury repo market. Those are equivalent in terms of investments. So arbitrage should make this spread 0. But of course, it's not 0. And in particular, it spikes more as the balance sheet normalization proceeded, because there just wasn't enough reserves in the system. Not enough in light of the capital requirements that Wenshin emphasized, but also not enough, as we will emphasize, to simply run the payment system in light of regulatory requirements. The spikes here are truncated at 200 basis points, so that you can see that it wasn't just September 2019. These spikes were happening all through the normalization period and were getting more severe as reserve balances reached very low levels. If you look, the last spike is the COVID spike of March 2020. And we believe that there was also not enough reserves in the system at that point in time. And that's evidence from the fact in the next chart that if you look at the blue line, which is the total amount of dealer balances among the large 10 repo active dealer banks, even after September 2019, when the Fed reversed course on balance sheet normalization, the blue line never really climbed that much. By the beginning of March 2020, the banks that were most responsible for providing funding in the repo markets had roughly the same amount of balances that they had at the beginning of September. It's those banks that matter with respect to these spikes, as our regression analysis indicates. The other banks are important too, but for reasons that I'll describe. You'll also notice that after March 2020, the balances of the 10 largest repo active banks grew enormously. That was a byproduct of the Fed's rescue of the Treasury market. The Fed bought up $1 trillion of treasuries in a few weeks, and and used reserves to pay for that. And that provided very ample reserves, super abundant reserves after March 2020. And you can see that the repo spread to IOR became as tame as a pussycat after that. There were plenty of reserves, and it takes plenty of reserves to keep that spread under control. I want to give you a verbal description of our main results because time is short, and I might not get through all of the actual analytical work. And Claudio's going to tell me when I have 5 minutes left, right, Claudio?
I'll start with 10. I'll start with 10, and then I'll tell you 5.
Perfect. Okay. Well, as I emphasized, this work is complementary to the work that Wenxin just presented. We know from their work, which precedes ours, that funding market liquidity depends a lot on the ampleness of reserves. And we learned that in their paper from the repo market and the FX market and their unique data set that they used that allowed them to track the reserve draining operations of these markets. In our work, we're focusing on the banks that are most active in the repo market, and we find that it's particularly their balances that matter, especially. We also find, and this is item number 3, that an even more powerful explanatory variable for what's causing these spikes and elevated repo rates is intraday payment timing stress on these 10 largest banks. And the metric that we're using for that is the time of day by which the repo active banks are getting half of their incoming payments. So let's say it's 2 o'clock. If it's at 2 o'clock on a given day that they're getting half of the day's incoming payments, if that's a lot later than normal, that's going to be a day where you're likely going to have a spike in repo rates. What explains those late incoming payments? It's when the other 90 banks, the other 9 large banks, have low opening balances. So you've got a whole systemic effect here. Let me repeat the causality, or at least the story for causality. We're not establishing causality in our regressions. If there's not enough reserves in the system, then the other large banks, the other 90 banks, are paying the repo active banks late in the day. That, in combination with low balances at the repo active banks, causes them to be very stingy with funding in the repo market, and you get spikes in the repo rates. An additional factor related to intraday payment timing stress, number 4, is that when the Treasury issues a lot of securities after an auction, these 10 large repo active dealer banks are paying for those treasuries early in the morning, adding to their intraday payment timing stress. Why are they paying early in the morning? Why don't they hold back on the timing of those payments to the Treasury Department for new Treasury securities? It's because the Treasury Department wants to be paid first thing in the morning. So if you're at a large repo active bank and you know there's a big Treasury issuance today, you're going to tell your repo desk, don't be giving out a lot of funding at cheap rates early this morning. It's going to be a big issuance day, and we need to pay the Treasury Department first thing in the morning. We're going to lose the discretion of when to pay them. Other important determinants are the supply of Treasury bills. We're seeing just lately that a lack of Treasury bills is driving down repo spreads. That's not related to our main story, but it's interesting. And it has already been emphasized, quarter-end capital requirements, and that's apparent from the discussion from Wenxin and Jeremy just now. So what about this issue of intraday payment timing stress? Well, let's go to JP Morgan's third quarter 2019 earnings call. This was the first earnings call after the September 2019 crunch. One of the bank analysts from Evercore asked Jamie Dimon, why didn't you arbitrage? These were giant repo spreads. You could have taken your reserves, which were plentiful, and invested them and made money on these repo spikes. And here's Jamie Dimon's reply, quote, we have a checking account at the Fed with a certain amount of cash in it. Last year, meaning when repos spiked earlier, in 2018, we had more cash than we needed for regulatory requirements. So when repo rates went up, we went from the checking account at the Fed, which was paying IOER, into repo. Obviously makes sense, you make more money. Parenthetically, that's the arbitrage that banks, you would guess, would have been doing. Going back to the quote. But now the cash in the account, which is still huge, it's 120 billion in the morning and goes down to 60 billion during the course of the day and back to 120 billion at the end of the day. That cash, we believe, is required under resolution and recovery and liquidity stress testing. Well, that's just a quote from one bank CEO, but it's consistent with all the evidence we have. And when you go to the actual regulatory requirements, they are extremely explicit and they are supervised. There's the CLAR tests, which are the liquidity analog to the CCAR capital requirement tests. And these are testing for intraday liquidity. It's not LCR, which is 30-day liquidity. These are testing for intraday liquidity. There's Reg YY, which if you read it, involves very explicit requirements covering intraday liquidity exposures. And then there is the RLAP, or Resolution Liquidity Adequacy and Positioning supervisory requirements, which require very explicitly that the bank is able to cover all of its intraday payment timing requirements without needing to go to the Fed and overdraft or use other sources of funding. So if you're at the bank holding company treasurer's desk and the repo market calls you in the morning, repo desk calls you in the morning and says, we're seeing opportunities here, would you give us more cash so we can invest it in the repo market? You're going to say, well, you know, I don't want to be responsible for us running our cash balances down. We're going to get in trouble with our supervisor. So no, you can't have much more money. And that's what causes the spikes. Here's some more evidence just looking at repo rate spreads. I'm showing you this chart, which we built from intraday transactions in the repo market provided by Tradition, just showing you that most of the volume is conducted very early in the morning. This is volumes in 20-minute segments of the day. And I want you to focus on the first 20-minute segment. It's the most active market determining segment. And it sets, as we show in our paper, it sets the tone for the market for the whole day. Now, go from that to this chart, which is the nub of the paper, really. The horizontal axis is the spread between the repo market and IOR in the first 20 minutes of the day. So these are the rates that repo traders are quoting early in the morning in basis points, spread over IOR. And you'll notice that to make it more visible, we put it, the grid is on a log scale. So 1 basis point in the middle, then 16, then 256. On the vertical axis is this metric we are using for intraday payment timing stress. It's how much later than normal you're getting half of your incoming payments. So 100 on the vertical axis means if there's a dot at 100, you're getting paid on that day 100 minutes later than normal, half of your incoming payments. The red dots that are scattered up to the right, to the northeast corner of this plot, are the days on which repo rates spiked for the whole day. Those are the SOFR minus IOER spikes. And you can see they're occurring on days typically when banks are getting paid late in the day. It's a payment timing stress story. Why are you getting paid later in the day? Well, it's because other banks don't have enough balances. These are the other 90 large bank balances on the horizontal axis. When those other large bank balances get low enough, they're paying the large repo active banks later in the day. And the repo active banks are getting, up to 100 minutes late. By the way, the little tiny red dot up in the upper left corner, that is September 17th, 2019. That is the spike day. That is the day with record low balances. It's the day with record low balances for both dealer banks and other large banks. It's also the record worst day for the timing of incoming payments. The banks are getting paid very late on that day. At least it's the record until September. The only worst day in the whole sample was the COVID sample day, which is I can't indicate it with my cursor. Oh, maybe I can. It's that day right there, which was 155 minutes late. That was the day on which COVID market stress also showed that there was insufficient incoming payments to keep markets liquid.
10 minutes, Daryl.
Good, just enough time. I'm not going to take you through all of these regressions, but I want to point out one or two. Go to column 3 and look at this explanatory variable for the spread between SOFR and IOR. It's extremely significant. It's the median time of receives. If you had to pick one explanatory variable for what's causing a spread, even more than opening balances, this one is explaining 36% of the variation when you combine it with the quarter-end fixed effect. This is a very powerful explanatory variable for what's causing those spreads, intraday payment timing issues. Now zoom all the way over to the far right-hand column, column 7, and look at the focus on Treasury's coupon issuance. I'll pick one of those. If it's a day on which there's a lot of coupon issuance, then you're going to get additional spreads between SOFR and IOR, and that's because of several effects. One, Wenxin emphasized, which is that it drains reserves. Another, which I emphasized, which is that it increases intraday payment timing stress because you must pay first thing in the morning. And another effect is that new coupon issuances are requiring financing in the repo market, so it also adds on the demand side. What explains these spiky days? We separated out the days with at least 30 basis points of spike in one of the main repo market segments. And then we did a probit analysis of the likelihood of a spike based on several explanatory variables. And let me just do this by example. The probit model says that if it's a day on which you're having a normal receive time for incoming payments, a sample average opening balances for the 10 largest repo active dealer banks, sample average issuance of Treasury securities, and it's not a quarter end, then the likelihood of a spike on that day is about 1%. If you hold everything the same, but you're getting paid later in the day by 1 standard deviation, which is 58 minutes later, your median payment time is 58 minutes later, that spike probability doubles to 2%. If you keep your late payment timing and you reduce opening balances at the large dealer banks, holding else the same, the probability of a spike doubles again to about 4%. If you go back to normal payment timing, normal opening balances, but it's a Treasury issuance day, that also causes a spike probability of about 4%. And if you put all 3 of those variables at alert conditions, high Treasury issuance day, low opening balances, late payment timing, the likelihood of a spike goes to 11%. And then if you go to a quarter end day, all of these numbers get very large. Spikes are very likely to happen on quarter ends. Last slide. And this echoes some of the discussion that Jeremy gave for Wenxin's paper. This is a confluence of policy issues. We're not taking a policy stance in this paper, but we want to illuminate some of the policy approaches that have been suggested to deal with this problem. One is, as Jeremy mentioned, we could just say, why not have more balances? Well, there are several criticisms of that. It would certainly cure the problems, we believe strongly, would cure the problems that have been addressed in this paper, but it has some potential downsides. One is that optically, at least, it doesn't look good for the Fed to pay a whole lot of interest on reserves to the large banks. Another is the one that Jeremy mentioned. If you have a lot of reserves and they're subject to the leverage ratio, which doesn't make sense, but it's there anyway, then you're going to impinge on bank capital requirements and crowd out other bank intermediation. And there have been some criticisms that giving the Fed plenty of reserves with which to buy things would put them in a position to conduct fiscal policy, or would put the administration and Congress in a position to ask the Fed to conduct fiscal policy because it has a large and expandable balance sheet. So those are the concerns with that approach. Another approach is the one that Jeremy emphasized. If you were to have a standing repo facility, then you would be providing reserves to the market just when it needs them and not otherwise. If you put a spread between the SRF rate and IOR, then market participants will come to the standing repo facility when they need to, not otherwise, and they'll cut off the top of those spikes. Another thing you could do is what Charles Goodhart suggested in his metaphor of the last taxi at the train station taxi stand. You could let the banks use the reserves that they have built up when they need them under stress. But instead, the banks have reacted to post-crisis liquidity rules and supervision by saying, no, we're not going to let these reserves go out and serve their proper function in a stressed market because we've been told that we need them in case there's a stressed market. Doesn't make sense at all. And of course, none of these issues would be present if the banks were in a position to draw on the discount window or to use daylight overdrafts, but there are stigmas associated with that. And of course, daylight overdrafts also blows through the liquidity rules and supervisory requirements. So here's 4 different policy approaches that could be used to mitigate this problem. And in combination with what Wenxin has said and in Jeremy's discussion, and I hope what will follow in Imen's discussion, I think we'll see that eventually the central banks will sort this out and they'll come to a more rational and harmonious way of both supervising and regulating the large financial institutions so that we don't have these very problematic spikes, which do raise concerns about financial stability, monetary policy transmission, and efficiency of payments and payments and funding markets. So with that, Claudia, let me turn it back to you and Imen.
Thank you so much, Daryl, and thank you for that vote of confidence in the central banking community. Let's hope that we as a whole can deliver on that. As I mentioned before, I will have to leave now and leave you in Andreas's capable hands. But I did leave a question with him that I hope he will ask at the end because I'm quite curious. We've talked a lot about restrictions on the supply of liquidity. There are questions about the demand for liquidity, and I think that would be important from the non-bank sector. So the discussant is Imen Ramouni-Rousseau from the ECB. She's in charge of the financial markets area. Imen, I don't quite see you, but I'm sure I will be seeing you in a minute or in a second.
Yes. Hi, Claudio. I'm here. Normally you should.
Yes, now I do. And again, I'm very, very sorry having to leave this session because I thought it's really excellent and there is much more to talk about. Hopefully you also tell us something about the Euro area own peculiarities because again, talking about segmentation, I think there is plenty going on there as well. Okay, thank you very much then. Bye.
Thanks, Claudio. Bye. So, hello everybody. Andrea, I'm waiting for your, signal whether I should start sharing the slides.
Yes, you can start sharing.
Okay, if you can just confirm to me that you see them correctly.
Yes, perfect.
In full screen?
In full screen, yeah.
Great.
There is some there is some box there which is invisible, but I guess if you just continue, I guess it will disappear. So
okay, I hope so, yeah. Let's tell me if it doesn't, yeah. So first of all, thanks very much for to the BIS for the invitation to this event, and I must say it's really a pleasure to be here. All the discussions are super interesting for us at the current juncture, And let me also start by saying that I really enjoyed reading the paper. So Daryl, Adam, David, I think it's a great paper. It's a great contribution to this, kind of interaction between things that are like central bank plumbing and monetary policy transmission, financial stability / regulatory reform, and even market infrastructure. So I think it's very important to have papers like these that try to embrace all of these perspectives, including some of the more kind of plumbing operational perspectives that are very relevant for us in markets. So let me start by just summarizing quickly the main findings of the paper and provide already a bit of euro area perspective. So the main analysis in the paper is the relationship between the total reserve balances of the largest dealer banks and the other large banks, intraday payment timing delays, repo rate distortions. Yeah, the timing period is between 2015 and 19, with an emphasis on the normalization period of the Fed starting 2017 and finishing in a bit in September 19 and then with COVID. Yeah. The main findings, 3 of them. First, the reduction in aggregate reserves and the new liquidity regulation, in particular intraday, resulted in intraday payment delays to the large repo dealers, who were then less willing to intermediate and, as a result, quoted higher rates in repo. Second, early morning settlement of treasury debt issuance can increase intraday payment timing stress. And third, higher aggregate level of reserves in the period leading up to September 19 may have alleviated the majority of payment timing stresses and repo rate spikes. Yeah, if basically we had really run a ample reserve regime at that point, rather than being a bit close to the minimum, so to speak. For the questions that the paper raised, I think Daryl's presentation of the diamond quote was illuminating. So it's not clear at all, actually, this quote. Yeah. So that cash, we believe, is required. I mean, for a CEO to say that, it's kind of surprising that these requirements are not clearer. Yeah, and that also they lead to this payment, to all these kind of inefficiencies and frictions in payments during the day. Second question that the paper raised is this thing of, why does a GSIB fear a loss of reputation where it uses intraday credit? Yeah. And this loss of reputation, as far as I understood reading the paper, is really just towards the central bank, yeah, and probably even more pointedly towards the supervisory arm of the central bank, just in case, basically, the information that you're using intraday credit gets to the supervisor, gets reported, yeah. Third, the dealers increase their reserves when they anticipate delays of timing payments. This is quite clearly explained in the paper, and I think this coordination problem during the day between the sequence of payments is well explained. But perhaps I struggle a bit more on the cause of the delays, or why they don't anticipate a bit more. But we'll get into that, yeah. And I think it's complex. And the last point is that it's not only the quantity of reserves, it's really the reserve distribution that matters, and therefore the policy conclusions have to address this question of how to affect the distribution of reserves. Yeah, and I think it's not an easy question. So I want to start really by showing what is real life on the repo desk in the euro area. So that's my repo desk. Yeah. So we put up this chart from a 2016 study we've done on 2 platforms. So MTS and BrokerTech. So this BrokerTech that had an outage, in the beginning of the week. And you can see that basically the life of the repo trader starts around 7 o'clock in the morning, and then there's kind of peak activity at the very start of the day. That's the yellow line that peaks, around 8 o'clock in the morning, and then it goes down the activity, but of course cumulatively, which is the blue line, it continues to increase. But I mean, the bottom line is that at noon, your day is done. You've done 82% of the volume on the repo market. And this is key because when it gets to noon, it's basically too late to respond to delays in incoming payments, yeah, in the second half of the day. You're done, yeah. And for me, it's also about the dynamics of how this repo market, works in terms of practices. And you said it very well, Daryl, in terms of the time that the Treasury elects to do the settlement of the auctions and things like that, yeah. So now let's have a look at concentration of central bank reserves. So the paper explained very well that when the Fed reserves of the dealer banks are higher, the concentration of balances among the dealer banks tends to rise, yeah? And the paper argues that the concentration of Fed balances among the 10 top dealer banks affects repo rate. And there, I mean, the point I wanted to make, and I understood, and we can discuss it a bit more, is that actually it's this whole point about the asymmetric incentives that Daryl explained, which is basically, okay, normally everybody has an incentive for the reserves to be better distributed, yeah? And when we will start normalizing as a central bank, yeah, so like when the Fed started in 2017 to normalize and so on, normally for the system as a whole, the incentive to better distribute it is even more, yeah? But the problem is at the level of the individual bank, yeah, the incentives are completely asymmetric. So if you allow the reserves to flow out and for the benefit of the system, you have a small P&L, yeah. So you get a couple of basis points more, yeah. If you allow too much to flow out, and then you have delays in incoming payments and stuff like that, your downside risk is huge, yeah. Your downside risk is basically you get a nasty call from your boss. The boss gets summoned to the supervisory part of the Fed. This doesn't look very nice, yeah. So clearly this is what we have to deal with at the moment, and we'll look at that in a moment. In the euro area, I just wanted to give this perspective. So I don't want to say that life here is bright and wonderful, yeah. We have other problems, but the concentration of reserves is a bit lower than in the US. And let me give you this chart that I'm sure you know, because this was from a speech by Benoît Cœuré in 2019, yeah, where you see, so basically the thing to look at is the top four. And you see that this red bar, the top four, is actually lower in the euro area than it is in the US. Okay, US would be in 2020 finishes around 30%. Here we are at 20% in the euro area. However, I wouldn't overemphasize, because when you kind of do the top 10, yeah, you add the yellow bar. Honestly, it's not so clear, yeah. So, but okay, maybe we're in a slightly better place regarding concentration. But okay, we have other structural conjunctural factors that play out, and we have this fragmentation across euro area countries and banking system, which doesn't exist in the US. And we can discuss whether this is, for the point of view of this distribution of reserves, good or bad, yeah, because it's bad in the sense that it's fragmentation. It's good because, in my view, it also means that there's more diversity among the players. The incentives are very different. They use different types of collateral, and somehow this kind of more diverse ecosystem can help. So market infrastructure, I really like that part. So I think that your papers are really shows how this kind of plumbing, market infrastructure issues, efficient payment settlement systems, they are key. They are not just a technical feature. They really aid the transmission of monetary policy, and they ensure financial stability. Yeah, and I think this, we have to be very aware of that as central bankers. And what what I wanted to mention in relation to in relation to the paper here is that clearly the importance of intraday credit is paramount. Yeah, I mean intraday credit should be easily accessible, free, without friction, without stigma, without limits, and so on. Yeah. So let's have a look at what we have in the euro area regarding intraday credit, and that takes place in the target 2 system. So these are graphs that come from a very nice box in the article in the ECB Economic Bulletin, May 2020. Yeah, and basically the point to see here is that in the euro area we have intraday credit, which is collateralized. Okay, it's free. There's no limit except the collateral pool that you draw upon, and we have the chance to have a very wide collateral system. Yeah, that also includes credit claims. Yeah, so it's absolutely huge. Yeah, and it's not stigmatized. So this is the point I wanted to bring across, is that I don't think that the supervisors get any reporting. I mean, first of all, there are way too many banks that access intraday credit every day to do any reporting. Yeah. And if you look at here, the intraday credit, you have a sense of that. So look, for example, here at the right-hand side chart here, the share of participants using intraday credit, what you see is that even in countries with very high excess liquidity, like Germany, which is this DE bar, second country starting from the left, you still have 10% of participants in target 2, the German participants, German banks that use intraday credit, yeah, every day. Yeah, I mean, it's down from 30% before, but it's still 10%.
Just quickly, maybe
yeah.
if you have 5 additional minutes,
Sure.
would that work?
Very clear. In the US, it's more complicated. We can discuss. I understand that there is, first of all, this potential reporting to the supervisor when you use intraday credit, but also that the rules for eligibility to intraday credit interact with some of the resolution dynamics, meaning that if you are close to resolution, you're probably not eligible to intraday credit at that point. Yeah, you are a secondary credit institution. Yeah, and you kind of cannot access intraday credit. And in doubt, basically, the banks hold a lot more reserves. That's the diamond quote. Yeah. So very interesting thing is that the Fed put up a consultation at the end of May to try to reform all of this. I also wanted to mention that in the euro area, we have a very efficient use of collateral with something called auto-collateralization. I will not expand on that, but I can if there are questions. But this underpins the kind of very efficient technical infrastructure. Liquidity regulation and the role. Well, I think the paper makes the point that, yeah, that some blame for liquidity regulation, but I want to get across also perhaps or launch the debate that also the bank's own liquidity management and discretion perhaps plays a role, and perhaps that's something that the paper could look at a bit more closely. Yeah, it was the role of internal liquidity governance practices in the banks. Yeah, and the other thing is that one way to phrase the debate about the distribution of reserves is that it's not about whether reserves were ample or not, but whether they were mobile or not, after all. Yeah. And I think the emphasis should be on the circulation of reserves when they are needed and when they are needed during the day. And finally, I want to touch on this point that Jeremy made already, which is, fungibility, imperfect fungibility between reserves and HQLA. Positive intraday balances, I discussed it already. That's something to improve there to make sure that there's no stigma on overdraft and so on. Let me really focus on the policy options. And there, the point to get across is this, and I really like your policy options, I must say, because they basically tell you what's the interaction between the central bank arm and the regulatory / supervisory arm. Yeah. And basically, my way of looking at this is to say your option 1, which is large balance sheet, yeah, is basically the central bank does all the job. okay, it kind of says, okay, the supervisor will not change. So I adjust completely the size of my balance sheet, not only to the regulatory requirements, but also to the frictions that come on top of regulatory requirements. But of course, this has a lot of side effects. You mentioned them. I would really, on my side, focus also on the footprint in financial markets, yeah, and also potential loss of independence, honestly, for the central bank. Option 2, I understand it as this is like, okay, the central bank doesn't run a huge balance sheet. It tries to optimize by having, you know, the standing repo facility, and we discussed it. So it's a way to solve a bit this trade-off, but it's still imperfect coordination. So policy option 3 and 4, which basically allow the central bank and the supervisor to work together, yeah. So everybody does a bit, yeah. So the central bank does a bit by having this higher use of the discount window, and the supervisor also does a bit by relaxing, and then probably it works much better, yeah. The euro area, I think we're very much in the same, you know, situation, but perhaps the only thing is that we have a bit more room on both axes, on the flexibility for the banks to obtain reserves, and also on the amount of reserves there is currently in the US. So, for example, the regulatory requirements on the level of reserves coming from stress tests and so on, intraday credit monitoring seems to be a bit lower, yeah. And also we have this very flexible set of facilities. We already have, in a way, a standing repo facility, so we also can move a bit more flexibly on that front. I finish by bringing up the 3 policy conclusions. The first one is that the intermediary role of the central bank would most likely remain much larger in comparison to the pre-crisis situation. The second one is that the Fed today faces a trade-off between a larger balance sheet and providing more flexibility to the banking system. And the last one is that there is a clear need for a dialogue, yeah, and potentially even coordination. And this happened a bit during COVID between the central banks and the regulators on the alignment of frameworks and interlinkages. Thank you.
Thanks very much, Iman, for this very insightful discussion, and also bringing in some of the elements from the euro area system and monetary policy implementation. So maybe just Daryl, if you want to perhaps just react quickly on Iman's discussion, and then afterwards we can collect a few additional questions.
Thanks so much, Andreas. I'll be very quick. Iman, that was a fabulous discussion. You covered all the bases, and somehow you managed to bring in both the ECB and Fed policy and digest and describe our paper perfectly. I'm very grateful. I agree. There's a lot of research to be done on what are the causes of these delayed payments. I think it's a factor in it is strategic complementarity. That is, if you think you're not going to get paid early, then probably you're not going to pay early. So when reserve balance, and that's going to happen when reserve balances are low. You don't care about when you pay if you have plenty of reserves, but you do care if you think everybody else's reserve balances are low, then you're going to not pay early because you think you're going to get paid late. Your point on the mobility of reserves is so perfect. There's plenty of reserves in the system if they were more mobile, and what would cause them to be more mobile were more profitable arbitrages from these spikes. And so you have this tense situation which others have suggested, well, if we just reduce the reserves in the system enough, the banking system will figure this out, markets will work, and people will come off the sidelines, they'll start trading repo, they'll provide intraday Fed fund market liquidity, and everything will be fine. But of course, the equilibrium is that's only going to work if it's valuable to be mobile, which means there's got to be some stresses to make it pay off. Maybe it's better to just have ample reserves. I have lots of other reactions, but maybe you and I can discuss them sometime, whether online or hopefully someday in person. Thank you so much.
Thank you very much. So then let's move to some general Q&A by the audience. Maybe I can also kick off with a couple of questions myself. So one is, you know, the demand side for liquidity essentially. I mean, you're covering a lot the supply side and in particular also the role of supervisory expectations about liquidity and so on. But how about the demand side in particular, the hedge funds and so on that we know also were heavily engaged in relative value trades, including before the 2019 period. So I'd be interested in some of your thoughts there. And then the other question is about stigma effects more generally, actually, because I mean, it seems that the banks have always been reluctant to really dip into their buffers, whether it's liquidity buffers or capital buffers, and it seems almost like a general phenomenon. We've even seen that in the money market fund space in the COVID crisis, where the money market funds didn't want to dip into their liquidity buffer. So I was wondering what more can be done maybe to alleviate the stigma of using buffers as a general point. And then I think Martin Oemke has a question. Martin?
Hi, everyone. First of all, let me say I really immensely enjoyed this session on reserves. It was really fascinating. So, thanks. My question is about quarter end. If I remember Daryl's chart correctly, where the paper was predicting the probability of a spike, quarter end made a huge difference, which kind of tells me that one of the perhaps almost no-brainer policy interventions would be for the banks that are subject to it to get rid of the quarter end snapshot type of regulation. And so my question is whether, Daryl, also Jeremy, whether you agree with that. And then if you do, perhaps, you have a view on what the impediments, perhaps political or whatever they are, to making that change would be. Andreas, what should I do? Answer your question?
We don't have more questions lined up, so maybe you can just go ahead and answering our two questions.
Okay, so quickly on the demand side, we don't think the fluctuations are as large on the demand side as on the supply side, but one that we did point out is Treasury issuance, which also increases demand for financing of new coupon issues. There are, of course, going to be spikes on the demand side as well. I think the TGA spikes that Wenxin emphasized are particularly important on the demand side. When the Treasury Department draws on reserves for whatever it wants to pay for, that stresses the supply of reserves, remaining supply of reserves. You could call that a demand or a supply shock. On the stigma, it's quite mysterious, but it's been an endemic problem at the Fed for years. And Imen's presentation clarified for me that it seems to be not necessary. That is, in the ECB, somehow the system is set up so that the drawing on central bank liquidity is not viewed as such a big deal. I'm not sure why it is that the largest US banks are so frightened to use daylight overdraft. Well, we know that it's these I think we know it's the supervisory requirements, but I'm not sure why the political economy or the regulatory environment of the US is so much different than the ECB. It's a great topic. On Martin's question about quarter end, I do agree. I think that's in premise of your question, Martin. That would be good to get rid of the quarter end requirements. They're just causing dislocations in the system, and it's not a natural economic effect. It's purely a regulatory artifact, and there's no reason for foreign. Here I'm going the other way. I think the U.S. got it right first. There's no reason for foreign bank regulators to take a snapshot when it's possible to smooth out these capital requirements over the period and not cause dislocations at quarter end. By the way, that doesn't mean that the capital requirement problem goes away, because it means that it bears equal weight on all days, but it's still inefficient to have a leverage requirement, as Jeremy emphasized. There is, I want to mention that there is also a quarter end of, well, I'm not going to take time for that right now. I'd actually be interested in Jeremy's reaction on this quarter end thing as well.
Yeah, I agree. I mean, I think it seems more inefficient to have it be on quarter ends. I think there's no magic. It's exactly what Daryl said. I mean, you'll smooth it out. There'll be some shadow costs. It won't be as spiky, but you'll still have some bindingness of constraint. But that does seem like a more sensible way to go.
Okay, we also have one more question by Matthias.
Or do you want me, Andres, just say a few words on what was said? Yeah,
sure.
Super quickly.
Sure.
The hedge fund question demand side. I think a lot also hinges on the NBFIs. Yeah, so NBFI, and let's think of NBFI access to central bank facilities, both on the asset side and the liability side. Yeah, and I think there the US is more advanced. We are less advanced. But this whole debate is going to be dominating in the next 2 years. Darren's point about why in the euro area intraday credit doesn't have stigma and so on. It's about actually the risk management rules applying to access to intraday credit. Yeah, it's about are you eligible? What are the eligibility rules clear? In the euro area, if you have collateral, you're eligible. That's clear, and you will always get intraday credit. I understand in the US that this kind of rules about secondary credit institution. You can look it up on the Fed website. It's all about this public consultation. Yeah, that basically restricted eligibility in certain situations. So it's kind of contingency-based eligibility criteria, and this introduces a lot of optionality, a lot of uncertainty, and you don't want that. Yeah. So I think they would work on that. Last question on the quarter end. Yeah, great question. But the thing is, yeah, two things about quarter end. One is whether for the supervisor, you calculate this thing on a quarter end or daily basis. And this is going to be reformed. Okay. So on the 28th of June, you will have the daily calculation. But then there's the day where you disclose to the market. Yeah. And of course, this will not change. You're not going to disclose every day to the market. Yeah. And so some of the perverse incentives will remain.
Great. Thanks, Iman. I think we still have one final question by Matthias Drayman.
Yeah, thanks for this. And I'm actually going to link up the three last speakers because Iman just mentioned NBFI, and both Daryl and Jeremy said, look, let's expand standing facilities, repo facilities to all, or introduce them. And Jerry said to all, basically, as long as you have good collateral. So my question is, I can see how it would help, but are there potential negative side effects? And that's questions for Daryl and Jeremy. If you would start expanding these standing repo facilities to NBFIs and to everyone. So if you're a hedge fund, you could come. If you're someone else, so would be interested to hear your views.
You know, so I'll take a stab. I mean, you hear people say, well, moral hazard. People, you know, hedge funds and all will borrow more aggressively, say, to do the Treasury futures basis trade, things like that. I have a hard time seeing the problematic aspect of it, the sort of moral hazard, if this is a well collateralized Treasury only facility. You know, what's going to happen if hedge funds do, in fact, there may be a behavioral response. Suppose they do, in fact, borrow more aggressively to do the Treasury futures trade. Well, what will that do? That will compress the spread. In other words, that will raise the price of treasuries. That will redound to the benefit of the U.S. taxpayer, so that the hedge funds don't become more profitable. It does require the Fed to lend more, but if they're lending on a completely collateralized basis and all the benefit is going to the taxpayer, I don't see that as and they're not losing money in any state of the world. I don't see that as, I mean, there is a behavior, but I wouldn't call that moral hazard in a negative sense of the word. So I think one has to be a little bit careful about just saying moral hazard in the sort of an indiscriminate way when you're thinking about an all Treasury and reasonably well collateralized facility.
Daryl, would you also have any views on this?
Jeremy and I happen to have been discussing this at length over the last few weeks, and he and I completely agree. There are also operational issues. I mean, if the Fed says we'll take treasuries from anybody in the world, then the Fed has to figure out how to do the operational side of that. But that's a small issue. A natural way to do this might be to allow anybody that can centrally clear at the Fixed Income Clearing Corporation, so that the Fed is either facing the FIC or facing market participants who are eligible for FIC participation. That operationally may simplify it, and that includes hundreds of broker-dealers and, of course, all the banks and the investment or the securities dealer affiliates of the banks. You do need to draw some sort of operational perimeter to make it convenient.
Mm-hmm. Okay, thank you very much for this great session, to all the speakers, presenters, discussants, and so on, and also to everyone participating for the active participation throughout the day. So that brings us then to a close. Good evening to those in Europe, and good rest of the day for those in North America, and we'll see each other tomorrow. Again, unfortunately, no nice dinner at such occasions, but yeah, wishing everybody some good rest. Okay, have a good rest of your day.